of the syllabus in the year 2021. Question 2A reads, a financial analyst has been tasked with evaluating a floating rate security which has a quoted margin of 90 basis points and is selling for 99.2510 shillings and matures in 7 years. Required, Roman 1, the floaters spread for life, 3 marks. Roman 2, explain 2 limitations of the spread for life, 2 marks. First of all, we are going to take the first part, the floaters spread for life. Now, candidates, in the context of fixed income securities, the floater spread for life refers to the average difference in yield between a floating rate note and the benchmark interest rate it's tied to over the entire lifespan of the floating rate note. Here, candidates were to calculate the floaters spread for life. Floaters spread for life. Question 2A. Floaters spread for life. So first of all, you put down the formula. The formula for floaters spread for life is equal to 100 into 100 minus the price plus quoted margin times 100 over the price. So this we multiply by that. 100 into 100 minus the price plus quoted margin times 100 over price. That is the formula for the floater spread for life. That is the formula, where price is the market price per 100 shillings per value. In this question, we are given 99.2510 shillings. That is the price. And the quoted margin is the measure of the basis points, which in this case is 90 basis points. We read that floating rate security which has a floating margin of 90 basis points. So quoted margin in the coupon reset formula measured in basis points is 90 basis points. That is the basis points. Then this price is the same as this market price. So we have all the inputs. This we divide by the maturity. So that is the formula. 100 into 100 minus the price over maturity plus the quoted margin times 100 over the price, where price is the market value of the 100 shillings per value. In this case, it is 99.2510 shillings. Then we have the quoted margin. The quoted margin is the quoted margin in the coupon reset formula measured in basis points. In this question, we have 90 basis points. This is 90 basis points. This is the price, which is the market price of the par value of 100 shillings. And maturity is the number of years to maturity. The number of years to maturity is 7 years. So we have all the inputs. We have all the inputs from the question. All we need is to substitute, then get the answer. 100 minus the price, 99.2510 plus quoted margin 90 times 100 divided by 99.2510. This we divide by 7, maturity. That is going to give us the floaters spread for life. Floaters spread for life. I take my machine and calculate. So this will give me 101.46 basis points. So that is the answer to part A, Roman 1. This is Roman 1. Then you have Roman 2. Roman 2, explain the limitations of the spread for life. Limitations of the spread for life. 1, uncertainty around the future. Uncertainty. Now, the spread for life is an estimate that is based on current and historical data, and therefore it cannot predict future changes in the benchmark rate or the credit worthiness of the floating rate note, right? The credit worthiness of the issuer of the floating rate note, because there are factors that can significantly impact the actual spread, and therefore uncertainty around or about the future is one of the limitations of the spread for life. It is an estimate that is based on current and historical data. Related to uncertainty around the future, we have the limited historical data as a limitation. Limited historical data. Now, if the floating rate note is a new issue, there won't be much historical data to estimate or calculate a reliable spread for life, and that makes it even more challenging to assess the future performance. Limited historical data in reference to, say, a new issue. 3, it doesn't consider reinvestment risk. The spread for life does not consider reinvestment risk. It only reflects the difference between the floating rate note yield and the benchmark. It does not account for investment risk. And as you receive coupon payments from the floating rate note, you will need to invest them. And if prevailing interest rates are lower when you invest, then your overall return might be lower than anticipated by the spread for life. So it does not consider reinvestment risk. That is a limitation. It also does not capture the call risk. It does not capture the call risk. It does not capture the call risk. Some floating rate notes have call provisions that allow the issuer to redeem the bond early. So if interest rates decline, and if they do so significantly, the issuer might call the floating rate note, forcing you to reinvest your principal at a potentially lower rate. And that disrupts the expected spread for life. So these are some of the disadvantages of spread for life. Explain two limitations. These are 4. 1, 2, 3, 4. Any two marks. Any two will earn the 2 marks. Part A of this question, 3 marks. Formula, working, answer, 3 marks. We've answered part A. Part B reads, a bond may include a provision that allows the issuer to retire or call all or part of the issue before maturity. Examine 3 disadvantages to an investor of a call provision clause in a bond. Now, this is a question from the topic, the term structure and interest rate dynamics. This is topic number 7, the term structure and interest rate dynamics. Examine 3 disadvantages to an investor of a call provision clause in a bond. B. Disadvantages of a call provision clause in a bond. The first disadvantage is early termination. How is it a disadvantage? Now, if interest rates fall after you buy a bond, the issuer can call the bond and reissue new ones with a lower coupon rate, and you would then be forced to reinvest your principal at a potentially lower rate, reducing your overall return. That is one disadvantage. Number 2, reinvestment risk. Reinvestment risk. Now, when a bond is called, you receive your principal back, but one may struggle to find a new investment with comparable interest rate, especially if rates have declined. And that can be particularly challenging in interest rate environments, in low interest rate environments. So there is that reinvestment risk. So a bond may be called, but the investor may lack an opportunity to reinvest the principal to earn similar interest rate, particularly where we have challenges in the environment in relation to interest rates. So that is a disadvantage, reinvestment risk. Do you understand? 3, lack of predictable revenue stream. That's yet another disadvantage of having a bond with a provision clause. Bonds offer a predictable stream of income through coupon payments. A call provision disrupts such predictability, potentially forcing you to find a new source of revenue earlier than expected. Do you understand? 4, reduced liquidity. reduced liquidity. If a bond is frequently called due to falling interest rates, it can become less liquid, meaning it can be difficult to sell the bond quickly. Why? Because investors become wary of holding such a bond, and that can make it harder to exit the investment if need be. Disadvantages. Another disadvantage could be in relation to the call premium. The call premium may not be enough. Call premium might not be enough. The call premium might not be enough. Sometimes bonds with call provisions offer a slightly higher initial coupon rate to compensate investors for the call risk. However, that premium might not fully offset the potential loss of future interest payments if the rates fall significantly. So these are some of the disadvantages of a call provision clause in a bond. One disadvantage is related to early termination, reinvestment risk, lack of predictable revenue stream, reduced liquidity, call premium might not be enough. 6 marks. Any three disadvantages would earn the 6 marks. That is part B. Part C of this question reads, Zainabu Anyango is analyzing two types of bonds, A and B. Bond A and Bond B, whose information she has gathered as shown below. So we have information in relation to Bond A and Bond B. The information is about the par value, maturity, coupon rate receivable, frequency of interest payments, first interest payment occurs. Bond is held up to interest payments reinvested at 8% and 8% respectively. Required Roman 1, the present value of annuity interest for Bond A and Bond B, 4 marks. Roman 2, the total value of the constituent components of bonds return for Bond A and Bond B, 4 marks. Roman 3, based on your computations in C1, in C2 above, advise Zainabu on the preferred bond to invest in. So we are required, first of all, to calculate the present value of annuity interest. B. Let's begin with Bond A. What is the present value of annuity interest Bond A? Now, candidates, we know that the present value of an annuity is calculated. The present value is equal to the future value times 1 plus r raised to n minus 1 over r. That is the formula, where future value is the interest annuity interest. The annuity interest, the interest rate from the question, coupon rate receivable is 10% and the par value is 20 million. So it's 10% times 20 million, which is equal to 2 million. That is the future value. That will be equal to 2 million times 1 plus r. R here is the interest payments reinvestment rate of 8% per annum. So 8% converted into decimal is 0.08 plus this one will be 1.08. We raise to the number of years, maturity 15 years, 15 years minus 1 over R 0.08. That's it. This will be the present value of annuity interest bond A. This is equal to shillings 54,304,227.85. That is the present value of annuity interest bond A. For bond B, what is the present value for bond B? The present value for bond B. Now, the annuity interest bond B is the 10% per annum, still 10% per annum, but candidates, you can see the frequency of interest payment here is not annually but semi-annually. So the interest receivable you've seen here is semi-annually. So the 10% is earned semi-annually. It is 10% per annum but earned semi-annually. So it's going to be a half of 10%. That will be the rate. You understand? Times the 20 million. The interest will be 5% times 20 million, which is equal to 1 million. This 1 million is earned semi-annually for how many periods? The periods will be the 15 years times 2, 30 periods. Our N here, we have future value times 1 plus R. This R we are dividing by 2. Then this N we multiply by 2 minus 1 over R. Right? R, we said we are dividing by 2. This R we divide by 2. So that will be equal to 1 million. This 1 million times 1.8% divided by 2 is 4%, 1.04 raised to N is 15 years times 2 is 30 years raised to 30 minus 1 over 0.4 over 0.4. That is how to work out the present value of annuity interest. Annuity interest. All right? Annuity interest. So this will be 0.04. 0.04. So I take my machine and get the present value. So the present value here will be equal to shillings 56,084 937.75. That is the present value of annuity bond B. We've answered Roman 1. We move on to answer Roman 2. What is the question? Roman 2, the total value of the constituent components of bonds return for A and B. The total value of the constituent components of bonds return. Constituent bonds return. You understand? The question is not requiring us to calculate the total of bond A and B. No, it is the constituent components of, first of all, bond A, then bonds constituents of bonds returns of B. So we are going to have two separate totals for bond A and bond B. And that will constitute the par value of the par value at maturity. Let's begin with bond A. Bond A, first of all, we'll have par value at maturity. The par value at maturity, bond A, is 20 million. 20 million. The par value at maturity is 20 million. Then we'll have the interest payments. The interest payments, we know the interest per annum is 2 million. That is interest per annum is 2 million. And this interest will be earned for a period of 15 years. So we have 2 million times 15 years. That will give the total interest. 15 times 2 million is equal to 30 million. That is 30 million. Then, apart from the interest payments, the coupon, the interest that was reinvested, interest on reinvested interest payments. Interest on reinvested interest payments. This interest that is received, we read from the question, was reinvested. That interest was reinvested to earn interest. Interest, we call it reinvestment income. It can also be known as the reinvestment income. You can see under bond A, interest payments reinvested at 8%. Interest payments reinvested at 8%. So what is this interest payment? So we need to calculate the interest payment that was reinvested at 8%. Now the interest on reinvested interest payments is simple to calculate. We will deduct the interest payments from the present value annuity interest. That will be 54,304,227.85 minus the 30 million. So this is just 30. So here we'll have, we get the difference between the value of annuity interest and the interest payments. So this will be equal to 24. Yeah, 54 minus 30 is just 24 because these are zeros. This is 24. 3 of 4.227.85. Yes, there is only 1 point there because there are 3 zeros here. So I push my point from this point 3 times. So that is the interest on reinvestment interest payments, also known as reinvestment income. Reinvestment income. So we are going to get the total because the question is total value of the constituent components bonds return for A and B. For bonds return for A and B. This will be equal to, I'm getting the total there, don't need a calculator there, 74,304,227.85. That is the total value of the constituent components of bonds return for A. Then we do the same for bond B. Total value bond B. We have the par value. First of all, at maturity, the par value at maturity for bond B is still 20 million. Then we have the interest payments. We add the interest payments. We had calculated the interest payments bond B is 1 million per period, and there are 30 periods. So it will be 1 million times 30 periods. 1 million times 30 periods, which is equal to 30 million. That is interest payments. Then lastly, we have the interest on reinvested interest. Interest on reinvested interest. Now, to calculate interest on reinvested interest, we take the difference between the present value annuity interest and the total interest. So the present value annuity interest, we had calculated it here, 56 million and 84,937 and 75 cents. This we deduct the 30 minus this 30 million. Let me have it here, minus 30 million. The difference between the annuity interest and the interest payments will give us the interest on reinvested interest. So 56 minus 30, this is 26. These are just zeros, so we have 26, 0, 84, 9, 37. This is 937, 26,084. This is 56 million and 84,937 37.75. So we are going to get that total. That will be the total value. The total value. Again, I don't need the calculator. This is 20 plus 30, giving me 50 plus 26. 50 plus 26, 76, 084, 937.75. 76,084,937.75. That is the total value, of the constituent components of bond B. Then we have the last part of that question. Based on your computations in C2 above, advise Zinabu Anyango on the preferred bond to invest in. And candidates, you can see the total return here is 76,084,937.75. The total return bond A, 74,304,227.85. That is the total return for bond A. You can see 74 and 76. So bond B has a more reinvestment interest than bond A. Do you see that? Because these two are the same. The par value of maturity is the same. 20 million, 20 million. The interest payments is also the same. The interest payments is the same. So the decision, the advice is based on the amount of interest on invested interest. What determines on which investment to take is dependent on the interest on reinvested interest. And you can see here, bond B has more investment interest than bond A, and therefore bond B is the best investment because interest is reinvested more frequently. In bond B, interest is reinvested more frequently. It is reinvested semi-annually than bond A. So from this question, you can see here, interest is reinvested more frequently. That's why the total reinvestment income for bond B is more than the total reinvestment income for bond A. So the advice here is that Zinabu Onyango should invest in bond B. Zinabu, this is Roman 3, Zinabu Anyango should invest in bond B. What is the reason? Because interest is reinvested more frequently. In bond B, interest is reinvested more frequently. That is semi-annually than bond A. Consequently, earning higher return on investment. So we've answered Question 2, December 2021. Part A, we've moved on to Part B. Part B, Part C, 4 marks, Roman 1, 4 marks, 1, 2, 1, 2, 4 marks. Roman 2, 4 marks, 1, 2, 1, 2, 1, 2, 4 marks. Then the advice, just 1 mark, 1 mark. So thank you for attending the lesson. In our next session, we are going to answer question number 3, December 2021. Please attempt December 2021 question 3 before attending that lesson. Make sure you go through the question first so that when you are revising, you will learn where your mistakes are and improve. I urge you to look for similar questions in the revision partner for fixed income investments analysis. The question that we've just done is tested from the topic on, that is question 2 is tested from the term structure and interest rate dynamics. Question 3 will be tested from the same topic, the term structure and interest rate dynamics. There is also part B of that question on valuation and analysis of bonds with embedded options. So please attempt the question on the embedded bonds with embedded options, valuation and analysis of bonds with embedded options. Thank you. Bye-bye.
Hello, welcome back to our revision session. In this session, we shall be looking at the December 2021 sitting of advanced taxation. So welcome, and let's solve the questions together. So we start with question 1 of the paper. Question 1 in the current setting is mostly a theory question, and so be keen to be able to look at it keenly. It will always be testing a number of topics, majorly 2 to 3 topics in most cases. So question 1A of December 2021 advanced taxation says, as economies continue to recover from the impact of the COVID-19 pandemic, tax collection in many countries continues to face challenges. This trend has resulted in some revenue authorities resorting to some drastic measures to boost tax revenue. One recent measure taken in monitoring of social media accounts and postings is, to access taxation compliance. Required. Justifying your response with practical reasons, argue the case for or against monitoring of social media accounts to assess taxable capacity and compliance. Note, marks will only be awarded for one position taken. Now, this question is testing what we call emerging trends in taxation. So that reminds you to be keen on all the subtopics in that topic, including issues like high tax, COVID-19 and taxation, tax agents, tax experts, and all that. So in this particular case, we are looking at the impact of COVID-19 in taxation and what tax authorities have resorted to do for them to boost their tax collection. So let's pick the question again. Justifying your response with practical reasons, argue the case for or against monitoring of social media accounts to assess taxable capacity and compliance. And we are told marks will only be awarded for one position taken. So in this case, you were to take one position. That means you are either to argue for or against the monitoring of social media accounts by tax authorities to boost tax collection. But for learning purposes, I've looked at both sides of the coin, so I'll then be discussing arguments for and against monitoring of social media accounts. But in exams, please, in such a question, take one position and talk about it in detail. So one, I'm talking about arguments for monitoring of social media accounts to assess taxable capacity and compliance. Now, today, many business activities are done digitally. So then digitalization and rise of social media has changed the way businesses or other firms conduct their businesses. A lot of firms today do their marketing activities online. A lot of them conduct business and communicate with their stakeholders online. And therefore, the move by KRA and other tax authorities to monitor social media accounts helps such authorities to maximize on their tax administration, and therefore digitalization, in short, and the rise of social media accounts enhances the way people conduct business today, and therefore the move by KRA to monitor social media accounts is a new frontier in tax administration. Number two is that tax is a constitutional obligation that everyone has to bear fairly, and therefore all people must pay taxes, and therefore nobody is to pay a shilling less or more than what they should actually pay. And therefore, the move by KRA to monitor social media postings is therefore a good one to complement the traditional methods or traditional tools that were used by such authorities to ensure tax compliance and administration. Three is that monitoring of social media accounts supplement what we call lifestyle audit activities, such as wealth declaration by taxpayers, in order to determine whether such taxpayers are tax compliant or not. And through such audits, such authorities, including KRA, have been able to make or rather take enforcement actions against non-compliant taxpayers. In other words, I'm saying that monitoring of such social media accounts supplement or complement lifestyle audits by tax authorities to ensure maximum tax compliant by taxpayers. So those are some of the arguments for, and as I said, I'm looking at both sides of the coin. So the second bit, I'm looking at arguments against social media monitoring by tax authorities. One is that most tax regimes, including Kenya's tax system, is based on what we call self-assessment by taxpayers, founded on honesty and trust, where taxpayers are required to voluntarily disclose information about their incomes to their tax authorities. And therefore, monitoring of social media accounts by tax authorities goes against this trust and voluntary declaration of incomes by taxpayers. Two is that social media monitoring by KRA and other tax authorities goes against what we call freedom of expression through the Constitution, as well as other instruments like the international instruments, such as the Article 19 of the UN Human Rights Convention. For many social media users, their postings and communication through social media is just for fun and for keeping their friends informed about their activities and lives. And so, when KRA and other tax authorities start monitoring such social media accounts, it infringes the the right of expression or the freedom of expression of such taxpayers. Three is that social media mining by tax authorities, including KRA, may or might punish those who cultivate false image of themselves in the social media or online. In some survey conducted by the British social media users, more than 75% of the people admitted that they were lying about themselves on social media. And that happens in Kenya and all over the world. Many people post information on social media which are not necessarily true about themselves. So today, for example, if I take photos in front of big mansions or big cars every single day and I keep changing them, if I post such on social media, that is not necessarily, may not necessarily be me. And so if KRA uses such information to determine or that to say that I'm not paying taxes as required, then that may not be true. I may end up being punished falsely just because I'm passing information on social media that may not be true about myself. So such as some of the arguments for and against the use of social media, or rather social media mining by KRA and other tax authorities across the world. That is part A of the question. The question is all theory, remember. So I move to part B of the question. It says, a delegation comprising government officials and entrepreneurs from a neighboring countries has visited your country, which is a beneficiary of the African Growth and Opportunity Act, AGOA, to learn more on AGOA and its benefits. A delegation comprising government officials and entrepreneurs from a neighboring country has visited your country, which is a beneficiary of the African Growth and Opportunity Act, AGOA, to learn more on AGOA and its benefits required. Prepare a brief to be presented to the delegation covering the following. Prepare a brief to be presented to the delegation covering the following. 1 is background information on AGOA. 2, conditions to be considered as an AGOA beneficiary country. And 3, trade benefits provided under AGOA. Now, this is a question on the topic economic integration. Now, economic integration in short is simply the grouping together of countries in a given geographical region for purposes of promoting trade among themselves. Now, that reminds you to look deeply into trading blocks, especially the East African Community, COMESA, and so on and so forth. But this particular one is on AGOA, that is African Growth and Opportunity Act, AGOA. Now, this is the background information on AGOA. AGOA is a piece of legislation that was approved by the U.S. Congress on 18th May, the year 2000. AGOA is a piece of legislation that was approved by the U.S. Congress on 18th May 2000. The objective of this legislation is to assist economies of the sub-Saharan African countries to improve the economy and to improve the economic relations between the United States and the region. AGOA completed its initial period of validity, and that was in the year 2015. And therefore, it was extended on 29th June 2015 by a further 10 years to 2025. Now, each year, the U.S. President determines the eligible countries from the sub-Saharan Africa to be part of the AGOA. Then AGOA provides duty-free treatment to goods designated from such sub-Saharan African countries to promote the economic growth through governance and free trade. In other words, the aim of AGOA is to assist the sub-Saharan economies to grow and promote trade between that region and the United States. So the key points to note here is 1, the formation of AGOA. Number 2, the countries forming AGOA. And 3, the key objective of AGOA. So let me pick it again, as you may be noting. Number 1, I've said that AGOA is a piece of legislation that was formed and approved by the U.S. Congress on 18th May 2000. The objective of the legislation is to promote and assist the economies of sub-Saharan African countries and to improve their economic relations with the United States. Then AGOA completed its first 15-year period of validity in 2015 and was further extended by 10 years to end in 2025. Then each year, the US president determines the eligible countries from the sub-Saharan Africa for the AGOA. Then how does AGOA benefit such countries? So lastly, I've said that AGOA provides duty-free treatment to goods of designated sub-Saharan African countries to promote economic growth through good governance and free markets. In other words, if such a country exports to the US, then the US government will not be imposing duty, that is import duty, on such goods from such countries. And therefore, this will make these goods to be cheaper in the US, and therefore such countries will be able to export more and sell more, and therefore benefit more from such a trade. 2, still on that, is conditions to be considered as an AGOA beneficiary country. Remember, we have just mentioned in the first part that every year the US president has the authority to determine which sub-Saharan African country joins AGOA. Now, you could say this in response to this. You say, AGOA authorizes the US president to designate countries as eligible to receive the benefits of AGOA if they are determined to have established or are making continual progress towards establishing the following. In other words, the US president looks at this for a country to qualify as a member of AGOA. 1 is market-based economies, that is, economies based on trade and economic growth. Number 2 is the rule of law. Such countries must be following the rule of law to the letter for purposes of promoting welfare of citizens in such countries. 3 is political pluralism, that is political inclusion, a case where every single citizen in such countries has the political right to do as they wish politically, of course within the limits. And 4 is elimination of barriers to the US trade. That is, such a country must not be imposing any trade barriers between it and the US government. 3 is trade benefits provided under AGOA. That is, what does a country benefit to be, from being a member of AGOA? So you can say the following are the trade benefits provided under the African Growth and Opportunity Act. 1 is promotion of economic growth, of course through trade or increased trade between the country and the US government. Number 2 is promotion of political reforms. Remember, one of the conditions to be met by a country to qualify as a member of AGOA is political pluralism and the rule of law. And so through AGOA agreement, there is promotion of political reforms in such sub-Saharan African states. 3 is improve US economic relations in the region. Remember, one of the conditions again that must be met by a country to become a member of AGOA is elimination of any barriers to the US trade. And so by eliminating such trade barriers, such countries are able to have improved US economic relations with themselves, which further promotes their economic well-being. That was part B of the question. Part C, still a theory, is saying alternative dispute resolution ADR is a method of handling tax disputes outside the judicial process. All applications for ADR should be through a suitability should go through a suitability test before the application is submitted for ADR. Let me pick that again. Alternative dispute resolution ADR is a method of handling tax disputes outside the judicial process. All applications for ADR should go through a suitability test before the application is submitted for ADR. Required: 1. Summarize the disputes that may not be suitable for the ADR mechanism. And 2. Describe the documents that must be submitted to support and facilitate the ADR discussions. Now, this is one of the emerging trends in taxation again, alternative dispute resolution mechanism. Now, as a measure to promote faster delivery of justice by the judicial system in Kenya, the government introduced what we call Alternative Dispute Resolution Mechanism, ADR. Now, this is basically any mechanism of solving or resolving tax disputes outside the normal court process, outside the normal legal process. So the question is, part A, summarize the disputes that may not be suitable for ADR mechanism for 3 marks. So you could say this, you could say the following are disputes that may not be suitable for the ADR mechanism. The following are disputes that may not be suitable for the ADR mechanism. This is as per the ADR framework in Kenya. 1 is disputes or suits which involve interest of the public or interest of several persons who are not parties before the court. In other words, ADR mechanism may not be applied in case a party to a dispute is not before the court. In other words, for ADR to be applicable, all the parties involved in such a dispute must be able to present themselves before the court, and if such a dispute involves the interest of the public, then such a dispute cannot be resolved through ADR. Number 2 is election disputes as to public offices. That is, disputes involving election issues that entail election of individuals to public offices, because that again is has public interest in it. And so any party, any dispute that involves or touches on the interest of the public cannot be resolved through ADR. 3 is proceedings which involve prosecution for criminal offenses. So criminal offenses cannot be resolved through ADR. In criminal offenses, it is the state that resolves the disputes, and so the individuals will have to go through the normal court process. 4 is special cases which involve protection of courts, such as claims against minors, deities, and mentally challenged. Remember, these are special groups which may not be able to participate effectively in the ADR process. So such special cases which involve protection of the minors, protection of the courts, such as claims against minors, deities, and mentally challenged, must go through the normal court process, facilitated by the government itself. 5 is cases which are related to serious specific allegations of fraud, fabrication of documents, forgery, and even impersonation. So such cases or disputes must go through the normal court process or the normal legal process, and therefore ADR is not applicable in such cases as per the ADR framework in Kenya. Part 2, the same, is asking, describe the documents that must be submitted to support and facilitate the ADR discussions. Documents that must be submitted to facilitate and support the ADR discussions. 1 is a summary of the issues in the dispute. That is, the particular issues which are being disputed in that particular case. So then the parties involved in the dispute must present to the court a summary of such issues that are in dispute. Number 2 is the relevant assessments, of course, in this case by the legal system. 3 is a notice of objection and all documents submitted to the commissioner. If there is any party in the dispute that is objecting any of the issues presented in the dispute, then a notice of such an objection must be submitted to the process. 4 is the objection decision, that is the decision arrived at as a result of the objection. Another one is a settlement proposal with basis in the law as may be appropriate, if any. That is any proposal by the parties on how to settle the dispute before the ADR process. And lastly, any other documentation as may be required during the ADR discussions. The court may require or orders the parties in the dispute to submit any further documentation. So in that case, such documentation become part of the requirement to process and facilitate the ADR process or mechanism. That answers question 1 of the December 2021 paper. Remember, in the current setting, I said question 1 is all theory, and in most cases it will test you on 2 or more topics at the same time. So be keen, especially on the issues of current trends in taxation and any other tax theory. That answers question 1.
Hi candidate, welcome to another session of Manifested Online Classes. We are still soldiering on with the topic of group accounts, and in our previous session we discussed on a very important concept, and the concept was piecemeal or the stage or what we refer as the step acquisition. And basically we say that this whereby the parent company, or basically the investor, a company, will actually acquire the control over the investee company through the successive purchase of shares. For example, in this case, we said we can be told that an investor company initially acquired 20% of the shares in the investee company, but later on acquired additional 40% of the shares in the investee company, and therefore the investor company acquiring the control over the investee company. Basically, we talked about a number of concepts as far as the piecemeal acquisition is concerned, and specifically we looked on how to prepare the group account or the consolidated financial statement as far as the piecemeal acquisition is concerned. So in this session, I want us to look on an illustration question so that we can be able to understand how to account, or basically how to prepare the group account in case of a piecemeal acquisition. So let's go through the illustration and we see what we are told. The illustration reads, H Limited, a public limited entity, has exercised significant influence over S Limited, another public limited entity, for many years before obtaining the control. H Limited acquired 40% ordinary shareholding in S Limited on 1st of April 2023, that is 2013, for a cash consideration of 2,500 million, when the retained earnings of S Limited stood at 360 million. So then you're told the draft statement of financial position for the two companies as at 31st of March 2023 are presented below. So we are given the statement of financial position for H Limited and S, where we have the non-current asset and which include property, plant and equipment, investment in S. We also have the current asset, which include inventory, trade receivables, cash and cash equivalent, and then at the equity we have ordinary share capital, retained earnings. We have non-current liabilities, which include 10% raw notes, and then we have the current liabilities, which include the trade payables and the current tax. Then we have additional information about, you're told H Limited acquired a further 30% interest in S Limited on 1st of April 2019 for a cash amount of 2,200 million. At this date, the retained earnings of S Limited amounted to 860 million, and the fair value of a previously held 40% interest in S was 3,000 million. Number 2, at the time of achieving the controlling interest in S Limited, the fair value of its identifiable net asset approximated their carrying amount, with an exception of the following items. Number 1, we are told an item of plant whose fair value exceeded its carrying amount by 150 million. Or basically, we are told an item of plant whose fair value exceeded its carrying amount by 150 million. And then you're told on 1st of April 2019, this item of plant had a remaining economic useful life of 6 years. Point 2, we are told on 1st of April 2019, the directors of H Limited identified that S Limited had an internally generated database of customers who had the potential of purchasing their product for an indefinite period of time. Although there was no contractual or legal right associated with this database, a professional expert estimated that a competitor of S Limited would be prepared to pay shillings 90 million for the database. And then you're told S Limited has had not yet recognized the database as an asset and as an asset in its individual financial statement. Then from there we have point number 3, which reads, the group policy is to measure and controlling interest at their proportionate share of the net asset in the subsidiary at the date of acquisition. So basically that particular information is to guide you which method to use in computing the goodwill on acquisition. So if you come across such information, when computing the goodwill, we use the partial goodwill method. Then number 4, we are told on 28th of March, 2023, H Limited sold goods worth 100 million to S Limited, and then you're told H Limited reported a gross profit margin of 20% on these sales. S Limited had neither received nor recorded these goods in its books of account as at 31st of March 2023. Number 5, we are told the current account between H Limited and S Limited did not agree due to goods that remained in transit as per note number 4. And then you're told as at 31st of March 2023, the trade receivables of H Limited included 6 million due from S Limited. And then you're told number 6, an impairment review carried out on 31st of March 2023 revealed that neither goodwill arising on acquisition nor the intangible asset with infinite useful life had been impaired. And then number 7, you're told ignore all the deferred tax consequences on acquisition and fair value measurement of S Limited. And number 8, we are told S Limited has not issued any ordinary shares since the date of acquisition. So what you're required to do, number 1, is to determine the equity accounted value of the investment in S Limited as at 31st of March 2019. And part B, we are required to calculate the value of goodwill arising on acquisition of S Limited as at 1st of April 2019. And number C, we are required to prepare the consolidated statement of financial position for H Group as at 31st March of 2023. So basically what we said is that once you come across such a question for group account, the first thing you need to do is automatically to come up with a group structure because that group structure will help you in terms of preparing the group accounts as required by the examiner. And number 2, you then need to do the necessary workings, which equally will also help you to prepare or basically to compute what is required. So therefore, the first thing we need to do here is basically to come up with a group structure, and then from there we do some few workings. So therefore, we start with the workings here. So our first working will be to come up with a group structure. We need to come up with a group structure. So where do we have this information about the group structure? That information, number 1, if we go back to paragraph number 1 of that particular question, we are told that the company which is called H Limited had acquired 40% ordinary shareholding in S on 1st of April 2013. And then if you go to additional information number 1, you're told H Limited further or acquired a further 30% shareholding in S on 1st of April 2019. So that is the information which will help us in terms of coming up with a group structure, because we are told the company which is called H Limited initially had acquired 40% shareholding in the company which is called S Limited, of which this 40% shareholding was acquired on 1st of April 2013. And then in the additional information number 1, we are told H Limited acquired a further 30% shareholding on 1st of April 2019. 1st of April 2019, and therefore on this particular date here, the parent company, or basically this particular company here, was able to acquire a controlling interest. Remember, we say that an investor company, or basically a parent company, acquires a control of another entity once the parent company acquires shares which exceed 50%. So therefore, the parent company, which is now H Limited, acquired a controlling interest over S on this particular what? Date. And therefore, this we refer to it as the piecemeal, or basically the stage or the step acquisition. So the parent company has been able to acquire a controlling interest over S Limited through successive purchase of shares. Initially, the parent company had acquired 40% of the shares in S, so mean that S initially was an associate, and then later on it acquired an additional 30% of the shares, meaning that S now is what? Is a subsidiary. Now, if you go to the requirement, specifically in part C of that particular question, the examiner is requiring us to prepare the consolidated statement of financial position. Remember what we said is that in preparing the consolidated income statement, number one, you need to check the status of this company during the year. So like in our case here, if you are required to prepare the consolidated income statement, take into account the current year ended on the 31st of March 2023, meaning that that year started on 1st of April 2022, you can see that the parent company here acquired a controlling interest, in this particular company here in 2019. In 2019, actually not during the current financial year. So basically what that means is that during the current financial year, then this particular company here, that is S Limited, was a subsidiary for the whole year. So therefore, if you are required to prepare the consolidated income statement, then what you'd have done is basically to combine or to add together similar items of revenue and expenses, those of H and those of what? S. And also, when preparing the consolidated statement of financial position as required in part C of that question, we say that we check the status of this company at the end of the year. At the end of the year, that is on the 31st of March 2023, this company is a subsidiary, and therefore in preparing that consolidated statement of financial position, we are going to combine, we are going to add together similar items of asset and liabilities, those of the parent and those of the subsidiary. So that is basically very, very important. The other thing which we also mentioned in our previous session is that when computing the goodwill on acquisition, we compute it on the date the parent company acquires the control. This that is on, in our case here, the parent company acquired the control on this particular date. That is the date we compute now the goodwill, and therefore it is important to note that, because that is one of the items we require to compute in part B. So but before we do that, we go to the requirement. I think we need to go through the additional information. We see which workings are required. So in note number 1, I think in paragraph 1, first of all, no working which is required there. In working, in additional information number 1, you're given information about the additional 30% shares which were acquired, the date when they were acquired, and also we are given the cash amount which was paid. This amount we are going to use it in the computation of goodwill, including the retained earnings of S on that date, that is on 1st of April 2019. Remember, that is the date we are going to compute the goodwill on acquisition, this date when the parent company acquired the control. So all the information we have in note number 1, we are going to use it in computing the goodwill, which is basically what we record to do in part B. And then let's go to the additional information number 2. We are told at the time of achieving the controlling interest, that is now this particular date here, that is the date the parent company acquired the controlling interest, we are told that S Limited fair value of its identifiable net assets approximated the occurring amount with an exception of the following items. So basically that is now what we refer as a fair value adjustment. The fair value adjustment. Fair value adjustment is a process through which the subsidiary company revalue the asset on the date of acquisition. Fair value adjustments, and basically these are fair value adjustments by our subsidiary, that is S Limited. So we are told that point 1, an item of plant whose fair value exceeded its carrying amount by 150 million, and then you're told on 1st of April 2019 this item had a remaining useful economic life of 6 years. So one of the assets which was revalued by S Limited here, which is the subsidiary, is a plant. is planned. So remember what we said in our previous sessions is that anytime the subsidiary company revalue the asset, the subsidiary company do not account for that revaluation. As a result of that, we make two adjustments. The first adjustment is for the revaluation gain, and number two, if the asset which was revalued is depreciable, we also have to compute the depreciation what other charge. So therefore, first of all, we have the revaluation gain, which is 150 million. And the reason why we are saying this a revaluation gain is because we are told the fair value of this asset exceeded the carrying amount. If the fair value is more than the carrying amount, or basically the book value, then whatever you have there is a revaluation gain. So this particular revaluation gain automatically was not accounted for by this company. Therefore, in preparing our consolidated statement of financial position, number one, this particular amount of 150, we are going to add it to the group PP, and number two, this we also treat it as a pre-acquisition revaluation reserve. So meaning that in computing the goodwill on acquisition of S, this will be one of the component of the net asset at the date of acquisition. Number two, we also need to compute the depreciation other charge. The depreciation other charge, specifically that is by which company? S. So how do we compute this? We take the revaluation gain, which is 150 million, divided that with the remaining useful life of the asset. We are told they are 6 years, and then we multiply that with the proportion of time. This particular depreciation other charge, we computed from the date the asset was revalued to the date of consolidation. To the date of consolidation. Remember, in our case here, we already have the date of consolidation here. Date of consolidation, which is 31st of March 2023. That is our date of consolidation. And then we know that the parent company acquired a controlling interest on that date. That is 1st of April 2019. And actually that is the date this company revalued its assets. So this actually we can say is the date of acquisition, or in other terms is the date the parent company acquired a controlling interest. So basically we need to determine how many years do we have here. So the first year here added 31st of March 2020, the other one 31st of March 2021, 31st of March 2022, 31st of March 2023. So we have 1, 2, 3, 4. So we have 4 years from the date the parent or S Limited revalued its asset to the date of consolidation. How many years? 4. So we need to multiply that with 4, and that will give us the depreciation what other charge by S Limited. So let's compute that. So we have 150 divided by 150 divided by 6 times 4, which will give us 100 million. Which will give us 100 million. So this particular 100 million, which is now the depreciation other charge, number one, this one will be deducted from the group PP. From the group PP, and also we are going to deduct this. This will also be deducted from the retained earnings of S. From the retained earnings of S Limited. So I think we are done with that. Let's go back to point number 2. Or additional information number 2, and we have point 2 of additional information number 2. We are told on 1st of April 2019, still the date the parent company acquired the controlling interest in S, the directors of H Limited, which is now the parent company, identified that S Limited had internally generated database of customers who had a potential of purchasing their product for an indefinite period of time. Now, according to IS 38, anytime the company has a database of potential customers, that should be recognized as an intangible asset. So, and therefore, this database of customers, it should be recognized as what? As an intangible asset. And then we are told that although the customers had the potential of purchasing the product for an indefinite period of time, there is no contractual or legal rights associated with the database, but a professional expert estimated that the competitor of S would be prepared to pay 90 million for that particular word database. In other terms, the value for this intangible asset, which is now the database of customers, is 90 million. And then you're told S Limited had not yet recognized the database as what? As an asset. So definitely, we are saying that database of customers who could purchase now the product of this company should be recognized as an intangible asset in accordance with what? International Accounting Standard number 38. And because it was not recognized by this company as an asset, when preparing now the consolidated statement of financial position, that database of customer will be recognized as what? As an asset. As an asset. Remember, in our case here, we are told that it had a value of 90 million. So how are we going to account for this? Number one, this one, when preparing the consolidated statement of financial position, would be added to the other intangible asset, if any, and then also treated as a pre-acquisition revaluation reserve. Pre-acquisition revaluation reserve. Also, if this particular database basically had definite period of time, we were supposed to compute the amortization. But in this case, we are told this particular database of customers basically has indefinite period of time, or basically these customers are likely to purchase the product of the company for an indefinite period of time. So therefore, this database is not supposed to be what? To be amortized. This intangible assets is not supposed to be what? To be amortized. So therefore, in this case, we don't have any amortization. We don't have any no amortization. No amortization on that particular intangible what? Assets. Okay, so we are done with that point. Let's move to point number 3. And point number 3, you're told the group policy is to measure and controlling interest at their proportionate share of the net assets. So basically, I've said that information is to be used in computation of goodwill. So as per that information, we are going to compute the goodwill on acquisition using the partial goodwill method. So we're going to use that information in part C when answering part B of the question. And then you're told on number 4, on 28th of March 2023, these are a few days to the end of the financial year, we are told H Limited sold goods worth 100 million to S, and then you're told S Limited reported a gross profit margin of 20% on these sales. H Limited had neither received nor recorded the goods in its books of accounts. So basically, this we refer to it. We refer to this particular goods as the goods in transit. The goods in transit. Goods in transit. Goods in transit. So when talk about the goods in transit, basically these are goods sold by one of the group member, but the purchasing or the buying company will not have received and accounted for those particular goods. So, and basically in this case, we are told the goods had a value of 100 million. So how do we account for this particular goods in transit, or which item need to be adjusted with these goods in transit in preparing the consolidated statement of financial position? Number 1 is that these particular goods, because they were sold by H to S, to S, number 1, we need to recognize them in the books of account of S Limited by doing what? By adding them in the group inventory. So we are going to add this in the group inventory, and then also we add them in the group trade payables. The group trade payables. So that is basically to recognize them. And then these particular goods will also result to two other consolidation adjustment. One is unreleased profit. We need to determine the unreleased profit on this good. And number 2, they also result to amount of intercompany debt. So therefore, number 1, I think we can determine the unrealized profit. So the unreleased profit basically will be on the entire goods, all the goods. So which will be the goods in transit times the gross profit margin, which are given as 20%. So this will give us 20 million. So this is unreleased profit. So, and this unreleased profit is automatically by the selling company here. So this one, number 1, you're going to less it from the group inventory. And number 2, we also deducted from the retained earnings of what? Of that company. And then automatically this gives rise to amount of intercompany debt. But if there is some information you given that in note number 5, that the current account of H and S did not agree due to this particular goods in transit. But we are told the amount, or in the last sentence of note number 5, as at 31st of March 2023, trade receivables of H included 600 million due from what? due from S. So basically that is amount of intercompany debt. Amount of intercompany what? Debt. So the amount of intercompany debt in our case, we are told is 600 million. 600 million. And this 600 million, number 1, will be deducted from the group receivables, or the group trade receivables, and also from the group trade payables. From the group trade payables. So that's basically the adjustment required for that amount of intercompany debt. So I think we are done with the point number 5. In point number 6, you are told an impairment review at the end of the year, that is at the date of consolidation, showed that the goodwill on acquisition are not impaired, and also this intangible asset. The intangible asset is referring to this database of customers had not been impaired. No working for that. Number 7, you're told to ignore deferred tax consequence on acquisition and fair value measurement by S. Equally no working for that. And then number 8, you are told S Limited had not issued any ordinary shares since the date of acquisition. Yes. So I think equally no working, which is required for that. So I think with those workings, we can proceed and answer part A of that question. So part A, what we are required to do is to determine the equity accounted value of the investment in S on 31st of March 2019. Now, it is very, very important for you to understand that before the parent company acquired a controlling interest in S Limited on this particular date here, previously this company, that is S Limited, was an associate. And actually what we are required to compute in part A is something called the investment in associate just before the parent company acquired what? The controlling interest. That is 31st of March 2019. That just a day before this. So what you're required to compute is the investment in associate. Investment in associate on 31st of March 2019. 31st of March 2019. Yes, so how do we compute this? To compute this, remember our figures are in million of shillings. So to compute this, number 1, we take the cost of investment. The cost of investment. So the cost of investment is basically the amount of money which the parent company had paid when acquiring 40% interest in S. 40% interest in S. So 40% interest in S. So where do we get that particular information? So, or that particular cost? So that one, we get it from the statement of financial position of H. That is a parent company, specifically at the non-current assets. There is something called the investment in S. Investment in S, and that figure is given as 47. But this particular 47 include the amount of money which was paid by the parent company in acquiring 40% shareholding and also 30% shareholding. So what you are given is the amount of money which the parent company had paid in acquiring what? In acquiring 40% shareholding. Actually, that one is given in paragraph 1, whereby we are told the parent company in acquiring 40% shareholding had paid 25. And then in the additional information number 1, we are told that when the parent company acquired the additional 30% shareholding, the parent company paid 22. So therefore, whatever you're given here as 47, it is a total of these two figures. So, but in our case, what we're interested with is this particular amount. So basically, we can just take this. We less 22 we get 25. Or alternatively, you can just take this particular amount here of 25, which is given in paragraph what? Paragraph 1. And then now to this, what do? We add the group share of post-acquisition retained earnings. Post-acquisition retained earnings. So what do you mean by the group share of the post-acquisition retained earnings? So in our case, we know that this particular associate was acquired on 1st of April 2013. And then the parent company acquired the controlling interest on this day. So mean that this company, that is S, was an associate between this period of time, or that date, 1st April 2013 and 31st of March 2019. So what we need to do here is to compute the group share of the retained earnings of S for this particular period of time. And how do we get now the retained earnings of S between these two dates? So number one, if you go back to the information we have in paragraph 1, we are given the retained earnings. We're given the retained earnings of S on this date, which was, as per paragraph 1, it was 360. It was 360. And then as per the additional information number 1, on this particular date here, when the parent company acquired the controlling interest, the retained earnings of S was what? Was 860. So therefore, how do we get the retained earnings between these two dates? So we take the retained earnings on that date, which is 860, minus the retained earnings on that date, which will give us, which is 360. So that now will give us the retained earnings of S between those two what date. And what we are interested with is the group share of that. The group share of that will be 40%, or the parent company share of that will be 40%. So we add it there. So let's compute that. We see what it will give us. So we have 860 minus 360, which will give us 500 times 40%, which will give us 200. Yes, 200. So we add the 2, and that will give us what? 27. That will give us 27. So basically that is it. That what was required as far as that part is concerned. And the marks allocated there were 2. So automatically the 2 items which were to be marked there is this one and that one. Yes. So let's move to part B of that particular question. Part B, we are required to compute the goodwill arising on acquisition of S Limited. Goodwill arising on acquisition of S Limited on 1st of April 2019. 1st of April 2019. So first of all, it is important here to recall that in case of a piecemeal acquisition, the goodwill on acquisition is always computed on the date the parent company acquired the control or acquired controlling interest over the investee company. So basically in our case, we know that the parent company acquired the control of the investee company, or basically over S, on this date. That date. And that's why you can see here the examiner was requiring the candidate to compute the goodwill arising on acquisition of S on which date? 1st of April 2019. So what we need to do here is to have 2 columns, and our figures are in million of shillings. So how do we compute this goodwill arising in a piecemeal acquisition? Number 1, we take the cost of additional investment. In this case, when we talk about the additional investment, we are talking of the additional 30%, the additional 30% shares, the additional 30% shares which were acquired by H in S, and I think we are given the amount which was paid, because that is what we refer to as the cost of additional investment. So that one is in note number 1. That on we are told that H Limited acquired a further 30% interest in S on 1st April 2019, paying a cash of 22. So to this, what do we add? We add the fair value of fair value of original investment. Fair value of original investment. So in this case, when we talk about the original investment, we are talking of 40% shareholding. 40% shareholding which H Limited had acquired in what? In S. And also we are given that value here. That is the fair value of the original investment in note number 1. Additional information number 1, where you're told the fair value of the previously 40% interest in S had a fair value of 3,000. 3,000, yes, 3,000. So that's basically what we add there, the fair value of the original investment. Equally, if for example we were using now the full goodwill method, because here we are using the partial goodwill method, if we were using the full goodwill method, we come and we add the fair value or basically we add the NCI at fair value. We add NCI at fair value. That is when using the full goodwill method, full goodwill method. But take into account we're using the partial, we are not going to add that value there. We get the total here, which will give us 5,200, and then to this word we less the fair value of net assets acquired. So by now we know how to compute this. To compute the subsidiary company fair value of the net asset on the date of acquisition, always we take the ordinary share capital of the subsidiary plus the pre-acquisition reserves, plus the reserves that subsidiary was having at the date the parent company acquired the controlling interest. So what we start with is the ordinary share capital of S. Where do we get that? In the statement of financial position of S, specifically under equity, and its ordinary share capital is 5,000. Then at equity we have the retained earnings of 1660, but that is not the amount which we include here. We include the retained earnings of this company on this date, which is given in note number 1, whereby we are told the retained earnings of S Limited on 1st of April 2019, the date the parent company acquired the controlling interest was 860. Also, we check whether that subsidiary company revalued its asset on the date of acquisition. Actually, revalued the asset on the date the parent company acquired the controlling interest. And we know that the subsidiary, that is S, on 1st of April 2019 revalued two assets as per the information given in note number 2. It revalued plant, this particular plant, which had a revaluation gain of 150, and we said that is a pre-acquisition revaluation reserve, and also it revalued database of customers, which had a value of 90, which equally we said is a pre-acquisition revaluation reserve. So we have the revaluation reserve or gain in respect to plant, which is 150, and also in respect to database of customers, which is 90. Yes, so those are the two revaluation reserve. So what we need to do here is we get the total, and because in our case we are using the partial goodwill method, we are only interested with the net assets which were acquired by the parent company. So let's get this particular total here. So we add this, we have 5,000 plus 860 plus 150 plus 90, which will give us 6,100, and then we get 70% of that, which will give us 4270. So we less it from the figure we have there, up there, 5,200, and that will give us 930. So that is now the goodwill arising on acquisition of S. And actually that what was required in part B of that particular question. The marks allocated there were 4. So automatically the items which are marked in such or the items marked there include that one, this one, and also all this. So basically by getting those particular items, a candidate was supposed to get all the allocated marks. Yes, so I think that is it. That what is required in part B. So let's move to part C. Part C is quite simple because we are required now to prepare the consolidated statement of financial position of this group, that is for H group. So in our case here, remember that H Limited, this is the parent company, whereas S at the end of the year is a subsidiary, because we said in preparing the consolidated statement of financial position in a piecemeal or stage acquisition, we should check the status of this investee company at the end of the year. The investee company at the end of the year is a subsidiary. So therefore, basically, in terms of how we prepare the consolidated statement of financial position, we add similar items of assets and liabilities of H and those of S as we make the necessary consolidation adjustment. So let's do that. This is part C, and this is H group consolidated statement of financial position, financial position as at 31st of March 2023. As at 31st of March 2023. So what we start with here are the non-current assets. So remember, we need to have a single column here, and our figures are in million of shillings. So when preparing this consolidated statement of financial position, it is important to note that we use the statement of financial position of individual companies, which is given under paragraph 2. So the first item of PP is, of non-current asset is PP, property, plant and equipment. So we are adding PP of the parent, which is H, and those of S, plus we make any consolidation adjustments. So here we have some adjustments. One of it is this revaluation gain on plant, which we said we add to the group PP. So here we add 150. And then we also have the depreciation other charge, this one of 100, which we said we less from the group PP. Do we have any other adjustment affecting PP? No. So we will get the final figures here. So then from there we have investment in S. Investment in S, remember, is the purchase consideration paid by the parent company in acquiring shares of S. That one we don't include it here. What we include here is any goodwill arising from acquisition, which we have computed here. That is 930. Okay, we don't have any other item, but we also have to recall that this company, on the date it was acquired, it had some database of customer, which you have said in accordance with International Accounting Standard number 38, that one should be recognized as what? As an intangible asset here. So we have intangible asset, which is customers database. Customers data base, and the database we are told had a value of what? Of 960. Not 960, but rather 90. Yes, so I think that basically what we have. Then before we get the final figure here, we can record the current assets. The current assets. So for current asset, we start with the inventory. So for the inventory, we add that of the parent, 27, plus that of subsidiary, 18. And then we check whether we have any consolidation adjustment affecting this. We have this particular goods in transit. So the amount of 100, we said we added to the group inventory. This one, we also have this unreleased profit of 20, which we said we less from the group what? Inventory. Do we have any other? No. So we will get the final figure there. And then from there we have the trade receivables. trade receivables equally we add those of the parent, that 120 plus those of the subsidiary 2180. Do we have any adjustment affecting receivables? Yes, we have this amount of intercompany debt, 600. So that one to be deducted there. And then finally we have cash and cash equivalents. Cash and cash equivalents. So for cash and cash equivalents, this one do not have any adjustment because we don't have any cash in transit. So we just need to get the final figure and then we get the total assets. We get the total assets. So let's get these final figures here. We start with the PPE. We start with the PPE here. So for the PPE, we have 5550, 5550 plus 4200 plus 150 minus 100. So which will give us 9,800. 9,800. Okay, so we compute the final figure for inventory, which is 27 plus 1800 plus 100 minus 20, which will give us 4580. What about receivables? We have 3120 plus 2180. That is 2180 minus 600, which will give us 47. And then for the cash and cash equivalent, we have 1130 plus 770, which will give us 1900. And then we get the total assets. The total asset, we add non-current and current. We have 19 plus 47 plus 4580 plus 90 plus 930 plus 98, which will give us a figure of 22,000, which are the total assets. We proceed, we record equity. So for equity, we start with the ordinary share capital. Ordinary share capital. And for ordinary share capital, we only record that of the parent company. So for share capital, we don't combine the share capital of the parent and that of the subsidiary. We only record that of the parent company. So then below that, we have the retained earnings. So this one, we are going to compute it as the last item. And then we will get the total equity. And then we compute something else called the non-controlling interest. The non-controlling interest. And also we include it there. We're also going to compute that together with the retained earnings. Then from there we have the non-current liabilities. Non-current liabilities, we have 10% loan note. So this is an item of liability. We combine that of the parent, that of the subsidiary. We have 1800 plus 12, no adjustment for this. That will give us 3000. And then we have the current liabilities. Current liabilities, we have the trade payables. Trade payables, we add those of the parent, 1560 plus 840 minus now, or basically we have some adjustment here affecting group payables. So one, we have this 100 million, we add it here. And then we also have this amount of intercompany debt, 600. So we less it there. 600, we less it there. These are plus 100 minus 600. Okay, we will get the final figure there. And then finally we have the current tax, or next we have the current tax. So for current tax, no adjustment for this, 350 plus 250. So this one we can get the final figure, which will be 600. 600. And then we will get the total equity and liabilities, total equity and liabilities. So, but before you do that, there are two items which we have not yet computed here, and that is what I want us to compute. That is the non-controlling interest and the retained earnings. So let's start with the non-controlling interest, and then we compute we start by computing non-controlling interest, then we compute the group retained earnings. So I think we can do away with this. Yes, so we start by computing the non-controlling interest. Non-controlling interest. So non-controlling interest, by now we know that these are the net assets, or basically this is the minority shareholders' share of the net asset in this subsidiary, in that subsidiary. So how do we compute minority shareholders' share of the net asset in the subsidiary? Our subsidiary is S. So what we do, number one, we take the net assets of the subsidiary at the end of the year. And basically the net assets of the subsidiary at the end of the year, we take equity, because net assets can be computed using two approaches. You can take assets minus liabilities, or you can just take share capital and reserves. That will give you one and the same thing. So therefore what we do, we take the equity of S, or the net asset of S at the end of the year, which is given as 6660. This one we get it from the statement of financial position of S as the total equity, But we have a number of adjustments to be made to that figure. One of the adjustments is that this company, on the date of acquisition, revalued assets, but it did not account for that revaluation reserve, which arose from the revaluation of asset. If that was accounted for, it was supposed to be part of the this net assets. So, and S Limited revalued two assets. It revalued plant, which had a gain of 150. It also revalued this intangible asset, which was database of customers. So that will give us a total revaluation reserve of how much? Of 240. The other thing which is also important to appreciate is that included in this particular figure here is the retained earnings of S. So therefore, anything to be adjusted in the retained earnings of S must be adjusted in this figure, because retained earnings of S is part of that. And we have a number of items, starting with what we have here. S Limited had a depreciation other charge of 100 million. So we take into account that depreciation other charge of 100, which we said should be deducted from the retained earnings of S. That's what we said. Deduct that from the retained earnings of S. That's what we are doing here. We are deducting that from the retained earnings of S. So here we don't have any depreciation or any amortization. Then we have this particular goods in transit, and we have this unreleased profit. This unreleased profit should be by the selling company, which is H, not S. Amount of intercompany debt, and so on and so on. So I don't think we have anything else other than what you have captured here, the depreciation other charge in note 2, and this profit in note number 4 is for H. Yes, so basically this is what we need to take into account, and then we compute the NCI share of this. NCI share of this would be equal to 30%, because as at the end of the year, the parent company will be having 70% shareholding in S, meaning that the NCI in S at the end of the year is 30%. So let's first of all we compute this figure here, 660 plus 240 minus 100, which will give us 68. And then we get 30% of this. 30% of that, which will give us 2040. 2040. Yes. So basically that is the non-controlling interest. So, and then finally what we need to do, let's compute the group retained earnings. The group retained earnings. So for the group retained earnings, this one is equal to 100% of H Limited retained earnings, and then 70% of S Limited post-acquisition retained earnings. So therefore, we have two companies here, our two companies here, H and S Limited. So what we do, we start by taking their retained earnings as given in the respective statement of financial position. Specifically at the equity, the retained earnings of this is 3940. For this one is 1660. But for this company here, that is S, first of all, we need to eliminate the pre-acquisition retained earnings. Pre-acquisition retained earnings is the retained earnings of S on the date the parent company acquired a controlling interest. That is how much? It's 60 as given in note 1, such that we will be left with only post-acquisition. So this remains the same, and then these remain 800. And then we also have a number of adjustments to these retained earnings. So we come back here. So number one, S Limited had a depreciation other charge of 100. Depreciation other charge by S of 100, that should be deducted from its retained earnings. And then we also have this unreleased profit by H. Unreleased profit by H Limited by H Limited, which is 20. So we deduct that from the retained earnings of what? Of H. There is something else we also need to recognize here that when the parent company acquired 40% shareholding in S, the parent company had paid how much? The parent company had paid 2500. But now, if you go to the statement of not the statement of financial position, but in note 1, on this particular date when the parent company acquired 30% shareholding, this original investment was revalued to 3,000. So this investment was revalued upward with an amount of 500. So this is supposed to be recognized as an income by the parent company. So therefore, because we are not preparing the consolidated income statement, so we come and we add it here. The revaluation gain on investment in S, which is 500. Which is what? 500. Yes. So I think those are the only adjustments which will be affecting that figure here, or which will be made now to these figures for the retained earnings. So we have 3490 minus 20 plus 500, which will give us 3790, and then this will give us 700. It will give us 700. Will give us 700. Yes. So then what we need to do is we get the group share of this. So the group share of this will be 100%, and then the group share of this will be 70%. Will be 70%. So this will give us 3970. What about this one? It will give us 490. That is 700 times 0.7, which will give us 490. So first of all, we add these two figures plus 3970, which will give us 4460. But also there is something else we need to include here, because what we have taken into account as far as the retained earnings of this company here, we have taken into account the group share of its retained earnings from this date here to the date of consolidation. But also remember, the parent company initially had acquired 40% shareholding in what? In S. So therefore, we also need to take now the group share of the post-acquisition retained earnings of S when S was an associate. And actually, that is a figure which we computed here. Because here we took the retained earnings on this particular date and the retained earnings on this date. We got the difference, which was 500, and then we got the group share of that, which was 200. So this figure which we have here. So we also add it here. So the total group retained earnings will be 4660. 4660. So basically what we need to do, we add all that. So first of all, this will give us 14660, and then we add what we have down there. We add 2040 plus 3000 plus 600 plus 600. Yes, and that basically will give us the same figure. Okay, there is something we have not included here. Sorry for that. Yes, so let's compute the payables figure. The payables figure, that figure is not yet included in the last column. 1560 plus 840 plus 100 minus 600. Yes, so we have a figure here of what? Let's take that afresh. 1560 plus 840 plus 100 minus 600. Yes, that will give us 1900. So let's maybe work that afresh. So we have 14660 plus 2040 plus 3000 plus 1900 plus 600. Yes, that will give us the same figure we have up there of 22,000. 22 what? 1,000. Yes, so basically that is it. That what was required as far as that particular question is concerned. And basically what we have been able to do is to illustrate how to prepare the group accounts, or basically the consolidated financial statement in case of what if as a piecemeal or a stage acquisition. So that brings us to the end of that particular session. See you in the next class as we discuss on a different concept of group accounts.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri and I practice within the financial services industry in Kenya. Today, ladies and gentlemen, we are going to learn about portfolio management. The focus will be on contemporary issues and emerging trends. We are going to narrow down our discussion towards case studies on application of portfolio management. I will read out to you case studies and provide for you some multiple choices, and then we can be able to try and answer together. So first question reads as follows. Jane Smith has an investment portfolio of $5 million. She is 68 years old, retired, and has no children. After her death, she wishes to leave her portfolio to a local art museum that has given her relatively free access to art exhibits over the past decade. Her health is better than average, and she maintains an active lifestyle consisting of frequent swimming, biking, and playing tennis with friends at her country club. Smith estimates that to maintain her standard of living, she needs approximately $250,000 per year. Expenses are expected to grow at an expected inflation rate of 2%. She states that as a retiree, her tolerance for risk is below average. Smith has come to you for assistance in investing her assets. So the questions I pose to you are right down there, ladies and gentlemen. Smith's return objective is closest to A, 3%, B, 5%, and C, 7%. Number 2, Smith's ability to take risk is most appropriately characterized as A, below average, B, average, C, significantly above average. Number 3, in terms of Smith's time horizon and liquidity constraints, Smith most likely has A, active investment strategy, B, risk controlled active investment strategy, C, enhanced index strategy. So ladies and gentlemen, we start by solving part A. And you can see there I have actually summarized to you on the screen. Smith states that she needs $250,000 annually to maintain her standard of living. This amount of annual expenditure represents what proportion? The proportion is 5%. How do we get the 5%? We get 250,000, which maintains her living standards, and we divide by the 5 million, which is part of the investment of her investment portfolio. Accounting for expected increase in expenses at the anticipated level of inflation indicates a return objective of 7%. How do we get 7%? We get the 5% as indicated as the annual expenditure amount, which is 5% of the total portfolio value, and then we adjust that for expected inflation, which amounts to 2%. So adding them up together, 5% plus 2% gives us 7%. So in this case, our option that we are going to select is option C, which gives us 7%. Part 2, we are being asked, Smith's ability to take risk is most appropriately characterized as. So we are saying that although her stated willingness to take risk is below average, the size of her portfolio, her good health, and relatively long time horizon indicate an ability to take average risk. But as a retiree, ladies and gentlemen, sensitivity to substantial declines in portfolio value is probably a concern. So even if it is said that she states that as a retiree her tolerance for risk is below average, we are saying that her ability to take up risk is average. And in this case, we are saying the answer to select is B. The third the third question rather, is saying in terms of Smith's time horizon and liquidity constraint, Smith most likely has, we are saying that barring any unexpected health related costs in terms of going to hospital and the rest, the inflation adjusted income needed will probably not change dramatically. Smith's concern for liquidity primarily relates to unusual cash flows. For example, healthcare costs, emergency spending, and so forth. That might take place during her retirement years, and hence she has no significant liquidity constraints at the moment. Smith has essentially a long-term time horizon for her portfolio until the end of her life, which could be another 20 or so years. So in this case, we select option C, a long-term time horizon and no significant liquidity constraints. So ladies and gentlemen, we can move forward to the next question. The next question is on your screen and it reads as follows. Joe Firmingham is a 38-year-old, married and has 2 children, ages 12 and 7. He recently received an inheritance of $300,000 and is considering real money for the first time. Firmingham likes to read the financial press and indicates that if he had money to invest in the past, he could have taken advantage of some undervalued security opportunities. Firmingham believes he has an average tolerance for risk-taking in investment activities, but he also enjoys skydiving every other weekend. The questions that are posed to you right down are indicated to you right down there. Firmingham's ability to take risk is most appropriately characterized as A, below average, B, above average, B, average, and C, above average. The next question is asking the most appropriate investment strategy for Framingham to take advantage of his stated propensity for finding undervalued investment is A, active investment strategy, B, risk control active investment strategy, and C, enhanced index strategy. Framingham, so the next question over there, or in trying to answer that question right there for you guys, we are saying that in Joe's case, the first question is asking Framingam's ability to take risk is most appropriately characterized as, we can say, or we can see from the question, that Framingham appears to have the ability and willingness to take risk. He frequently enjoys risk-seeking activities such as skydiving. His relatively young age indicates a somewhat long time horizon for his investment portfolio. These facts couple ability and willingness to take an above average level of risk. So in this case, ladies and gentlemen, we can say that Framingham's ability to take risk is most appropriately characterized as above average. The next question posed was the most appropriate investment strategy for Framingham to take advantage of his stated propensity for finding undervalued investments is, we are saying that Framingham indicates from the question that he follows the financial press, and has spotted what he considered to be undervalued securities. This activity indicates that Framingham pays attention to security valuation issues and that he probably will do so in the future. His portfolio, therefore, should follow an active investment strategy. And in this case, that is option A. So, ladies and gentlemen, this brings us to the end of case studies on application of portfolio management. If there are other case studies that you would be able to present through the portal or the comment section right there on Manifested Publishers website, please feel free to post them on the comment section of the Manifested Publishers website, and we will be glad to answer them. Thank you for being with Manifested Publishers, and God bless you.
Hello learners, and welcome to the Business Data Analytics session. I am your illustrator, Nicholas Sikali. Today, we are going to tackle a question on the statement of cash flows and see how we can be able to solve a question on the statement of cash flows using Excel. The question that we are going to use is the one that was brought by Kasneb through its pilot paper that was released recently. A sample of the pilot paper is what we have before us here. So I'll be opening a sample of the pilot paper so that we can see how it looks like and how your questions are going to look like. So this is the pilot paper, a sample that was just released the other day. The pilot paper for Business Data Analytics, which is a practical paper, consists of two sections. We have section 1, which has a total of 40 marks, and it is tested through multiple choices, because in this section, students are required to pick the correct choice from the given multiple choices. Now we also have section 2. Section 2, which is a total of 60 marks, is where now you'll be required to solve much of these questions using Excel. Like there is question 21, which you are required to prepare a spreadsheet showing a forecast statement of profit or loss, of course, for the next 3 years under the scenarios that have been given here. So this is a sample of how you can be able to prepare such a forecast of the statement of profit or loss, of course, using the rates given. Then we had question 22, that is the Rubini Limited, where students were required to prepare a statement of cash flows, of course, for the years ended 30th June 2021 and 30th June 2022, still using Excel. Then there was question 23, where you are required to apply your financial management knowledge to be able to solve this question here. Of course, it has aspects of net present value, discounting rates, and all those other items. Today, we are going to solve the question on statement of cash flows. This is question 22, where it's reading, you are provided with the following extracts of the statement of profit and loss and the statement of financial position for Darubini Limited for the years ended 30th June 2020, 2021, and 2022. Of course, this is the statement of profit or loss extract for the 3 years. Then we have the statement of financial position as well for the 3 years. Then we have the required, prepare the statement of cash flows for the company for the 2 years ended 30th June 2021 and 30th June 2022. Of course, to be able to do this particular question, especially part A on the statement of cash flows, we will export or convert this PDF file to Excel. So I'll be able to provide or convert this particular file to Excel using the tools that are available. And once converted to Excel, we will be able now to solve it. So here it is. I've pulled the same question. That is the Darubini Limited statement of profit or loss extract for the years ended 30th June, course 2020, 2021, and 2022. This is the exact question that I've pulled from the PDF format. Now it is in the format of Excel. And having gone through it, we have required, prepare the statement of cash flows for the 2 years ended 30th June 2021 and 30th June 2022. Of course, all that gives you total of 8 marks. Your knowledge of preparing the statement of cash flows has it that there are 2 methods of preparing the statement of cash flows. We have the indirect method, and we also have the direct method. Remember, the indirect method is where you are required to adjust your profits, of course, your bookkeeping profit, for the effects of those items which are not cash in nature, like depreciation, amortization, and impairment. You also adjust that for the items or transactions which are not operating activity, things like gain or losses from the sale of non-current asset. And we also adjust it for the effect of accruals. So if there is any accrued expense, you're also supposed to adjust for it for you to be able to get cash generated from operating activity. Then we have the direct method of preparing the statement of cash flows. The direct method is used where all the information that will enable you to get the gross cash receipts and gross cash expenditures or payments, of course, those methods of getting such things have been provided. Now, in our question here, we can be able to use both direct method and indirect method, but I'll go straight and use the indirect method of preparing the statement of cash flows. So cash flows are categorized into 3. We have cash flows from operating activities, we have cash flows from investing activities, and finally we have cash flows from financing activities. So we are going to start with the cash flows. Cash flows from operating activities. Cash flows from operating activities. That is the first heading of cash flows here. From operating activities. I'll, of course, make that bold, and I'll also underline that. I'll bring the currencies, or before the currencies, I can be able to bring the years. They said 2021. I'll also bring the other one, that is 2022 as the year. I'll also bring 2022 that way. Maybe I can center that it is well centered like that. Perhaps this could be here, this way, so that I bring the currencies for those respective years that way. This one can also be made to be bold made to be bold. Then our cash flows from operating activities. For you to be able to get cash flows from operating activities using the indirect method, then it means that we can use any of the profits here. You can start with the operating profit, that is profit before interest and tax, if you want. You can start with the profit, this is profit before interest and tax. There is profit before tax. There is also net profit. There are 4 profits here that you can be able to use. There is net profit, there is profit before tax, there is profit before interest and tax, and if you so wish, you can even start with operating profit. So depending on the profit that you start with, of course, that is what will really matter when making adjustments here. Like if you start with operating profit, then there will be no need of making adjustments for depreciation, which we see here. If you start with profit before interest and tax, then of course you must adjust for depreciation. And of course, when you start with the net profit that is below here, then it means you also adjust for so many items there. So I'll pick profit before interest and tax. Profit before interest and tax there. I'll not make it bold. So profit before interest and tax, in this particular case, this one for 2021, profit before interest and tax for 2021 is that. Then we also have profit before interest and tax for 2022 is this. So Control V there. So Control V, so that is profit before interest and tax. Once we have profit before interest and tax, of course, we will add back. What can we add back? Profit before interest and tax, we'll add back depreciation. So depreciation was given as 800 and 750. So I'll be adding back depreciation. So add back depreciation. Add back depreciation. Of course, this one is not to be bold. This one is not to be underlined. So depreciation is 800 and 750. So I'll use 800 here. And I'll use 750 there. And 750. So it's supposed to be in bracket. So I'll adjust this. More number formats. I'll go to custom, scroll down, and find the one that is exactly showing that, which is here. I'll click on it, and of course you can see it's in bracket now. So you add back depreciation. You check for any other thing to add back. If at all given in the additional information, there was nothing like that. Of course, for profit before interest and tax, it means finance cost is yet to be deducted. Tax expense is also yet to be deducted. So you won't adjust for those. Then this will give you operating profit. Operating profit before working capital changes. Operating profit before working capital changes. That will be given by this. I think something is wrong somewhere. We are adding back depreciation. So that is 800. And this one is 750. So yeah, 750. So that we get equal sign. So we are adding it back because it had been deducted before arriving at profit before interest and tax. So remember, depreciation had been deducted, so you add it back. So this is that plus this. Get that. Then again, equal sign, this plus 750. And it will give you your answer of 27,506. So that is profit, operating profit before working capital changes. Now we want to go to changes in working capital. When we talk about working capital, we are referring to inventory, we are referring to receivables, and we are referring to payables. So we are going to look at those items and see how they changed. For starting with the inventory, and you check 2020, 2021. So inventory here was 15, here it was 21,750. So that is the increase in inventory. So increase in inventory. When you talk about increase in inventory, that one is an outflow. When inventory increases, it means that you went and purchased inventory. So increase in inventory will be given by what we had here. You subtract this, then you'll get your increase in inventory, of course, which is an outflow. So that is increase in inventory. Here will be equal sign. Inventory increased from this minus 27,488, and of course the increase in inventory there is 5738. Of course 5738. So this will be there. It is fine that way. Then there is also receivable. It's also increasing. So we also have increase in receivable, increase in receivables, so equal sign. Now receivables are increasing from this, cost minus this, so that is increase in receivables. On the other side, receivables is increasing from 8750, cost minus 15460, and that one gives you that increase in receivables. Then we look at payables. Payables, they are also increasing. So increase in payables. Remember, increase in payables are inflows and not outflows. So increase in payables, it means you've received more money, or you went and purchased goods on credit. So that one is treated as an inflow. It will be equal sign. Increase in payables. Now we use this minus this one. It's an inflow. The other one will be equal sign here minus this, and that one is increase in payables. So that becomes increase in payables there. After that, we will be getting the cash generated. Cash generated from operations. Cash generated from operations. Cash generated from operations. The spelling of operations looks wrong. That is cash generated from operations. Now on cash generated from operations, it will be the aggregate of what we have here. It's operating profit before working capital changes, plus increase in inventory, plus increase in receivables, plus increase in payables. You'll get your cash generated from operations. The same, equal sign, this plus here, plus here, plus increase in payables. Of course, you get the cash generated from operations. So that is cash generated from operations. Once you have that, of course, we move to finance cost paid and also income tax expense paid. So finance cost paid and income tax expense paid. We check if at all there is any additional information that would affect that to necessitate a control account, but there is none. So finance cost paid, finance cost paid. So finance cost paid here will just be what we have here. Finance cost paid, let's use minus. So the finance cost paid is 7,000 here. 7,000. So you can as well just say equal sign 7,000, equal sign 7,000. The other side, equal sign 9,000. So you can see equal sign 9,000. It takes this. So that is finance cost paid. What about income tax paid? Income tax paid. So the income tax paid, the same tune. There is this 4343. Then again, equal sign 5327. That gives you 5327. So that is income tax paid. This will give you the net cash flows from operating activities, net cash flows from operating activities, which will be the aggregate of cash generated from operations plus finance cost paid plus income tax paid costs, and you get 2840. The other side, this is 16,389. You add 9,000. You add 52. Remember, the ones that are in bracket are outflows, so it will just deduct and give you the answer. So that is 2062. So that is net cash flows from operating activities. Net cash flows from operating activities. After that, we move to cash flows from financing activities, not financing but investing activities. From investing activities, cash flows from investing activities. And on cash flows from investing activities, of course, we'll be seeing the changes in property, plant, and equipment. Remember, this property, plant, and equipment can only be affected by three things. One, acquisition of new property, plant, and equipment. Two, revaluation of property, plant, and equipment. Three, a disposal of property, plant, and equipment. That is if the PPE has been stated at cost. But if the PPE has been stated at net book value, then depreciation as well will be affecting property, plant, and equipment. So what we have here, reported as PPE, I believe is at net book value, and it will as well be affected with depreciation. Now, the only change here that we are going to get on investing activity will be, of course, whether it's acquisition of property, plant, and equipment. We are going to see that. If this is the opening balance of property, plant, and equipment for 2020, then this is the closing balance, which has increased so immensely. You can see from 25,800 to 45,200. That can only tell you one thing. The business purchased new items of property, plant, and equipment. Remember, there is no revaluation. Under equity here, there is no revaluation, so there was no revaluation that was carried out. So the only thing that affected property, plant, and equipment must have been acquisition and depreciation. So it's acquisition and depreciation. So what we do for you to be able to get what was purchased is that you take balance at the end. Of course, balance at the end. On it, you will add depreciation that was charged. Depreciation that was charged. Then you deduct the balance at the beginning. That will give you what was purchased during the year as far as property, plant, and equipment is concerned. So that is cash paid to acquire PPE, or you can write it in full, property, plant, and equipment, to acquire property, plant, and equipment. So the solution will be equal sign. You take the balance at the end, that is at the end of 2021, add depreciation that was charged during the year. It's better we choose this, same as this, yes, but I want to use this because this is what that will be, the one that will give us adding. If you use this, it will be subtracting, which is wrong because they are in bracket. So we'll be using 800. You add 800, so I've clicked on 800. You less balance of PPE at the beginning of the year, which is 25,800. So you click on 25,800. What remains here there is what was paid to acquire. That is the balance on the debit side of PPE account, which gives you 20,200. The same case as this, equal sign. The balance at the end of the year 2022 is 46,700. So you click on 46,700. Add depreciation charge for the year was 750. Then you less balance at the beginning of the year, which was 45,200. So we have 45,200 here. Then you enter. That gives you 2,250 as cash paid to acquire property, plant, and equipment. But they're supposed to be outflows, of course. They're supposed to be outflows, so we'll find a way of making them outflows. Let's see. If we go to custom, custom, click on OK. It's still not bringing. So we will find a way of having that. The answer was, let me move back. You can see the answer is 2200 and 2250. So 2200 and 2250. 2200 and 2250. 2200 and 2250. So this is 2250 because it's an outflow. This one should be 2200. It was 2200, I believe. 2200. Let me confirm. Must have been 2200. Yeah, 2200. So this one is also 2200. So it needs to be in bracket because it's an outflow, 2200 and 2250. So I believe you've seen how we got 2200 and 2250. Now there is no any other investing activity apart from that. There are no other non-current asset that we can use. So we'll be getting net cash flows from investing activities, net cash flows from investing activities. Of course, the same answer that we have here. The same answer that we have here, net cash flows from operating activities. I want this bold because it's such a major heading. Then finally, cash flows from financing activities, cash flows from financing activities, cash flows from financing activities. Now on cash flows from financing activities, you will be looking at the long-term borrowings and you'll be looking at the equity, how the equity changed, Now on long-term borrowing, you can see it's increasing. Long-term borrowing here is increasing. When it's increasing, it means it's an inflow. You borrowed more funds, so it's an inflow. So equal sign, that is increase in long-term borrowing, and it will be equal sign this minus the other one, because of course it's an inflow. The other one is also increase in long-term borrowing, 60,000 minus 46. That is also an increase in long-term borrowing. Then we go and check what happened in equity. Paid up capital remained the same, so it means that there was no change. Look at what happened in retained earnings. We want to assess and check whether there was dividend paid or not. Now look at this. There is retained earnings balance brought down of 70/80. Balance brought down of 70/80. Now on this balance brought down of 70/80, the balance carried down was 30/53. So we want to see how. Of course, 70/80, let's just see this one, 70/80. If you add profit for the year, remember there is profit for the year 2021 here. So you click on that, it gives you 30/53, which is the 30/53 that is here. So it means there was no dividend that was paid. So there will be no dividend. Let us also test the last one, equal sign. They started the profit of 30. They ended with a profit of 15,482. We want to see how. So balance brought down of 30/53. Add profit for the year of 12. There's a profit for the year of 12,429. Let's see if we'll get the 15 here. If you enter, the answer is 15,482. So that is fine. Again, there was no dividend that was paid. So it means this will be the only cash flows from financing activities. So that will be net cash flows from financing activities, net cash flows from financing activities, net cash flows from financing activities. Of course, it is the same answer that we have there, the same answer that we have here. The last part is to aggregate all the cash flows and get cash and cash equivalents. Cash and cash equivalents. That way. So cash and cash equivalents for the year is an aggregate of cash flows from operating activities, add cash flows from investing activities, add cash flows from financing activities. So equal sign 2840 plus 2200 plus 13334. So that is 4026. The other one equal sign this plus that plus this. We will get 13145. Cash and cash equivalents brought down. Then we have cash and cash equivalents carried down. So cash and cash equivalents brought down, because that has been given, equal sign. The cash that you started with in 2021 was the cash that ended in 2020. So cash and cash equivalent here is 0. Add bank overdraft that was here, 5297. Of course, you get 5297, but it should be an overdraft. So equal sign 0 minus this. So it's an overdraft. The other one equal sign 0 minus 9322. It's an overdraft of that one. Now cash and cash equivalents, when the period was ending, of course this will be equal sign this plus that. 9323. 9323 is the answer. Here you can see that cash at the end of the year, that is 2021. If you move down with the 2021, 0. Then this one is an overdraft of 9322. 9322. So this and this should be the same. They should be the same. 9322. This one is 9323. So they are not. Equal sign. Let us test the other one. This plus this. That is 3823. 3823. 3823. Let us confirm. It is an inflow. There is money. There is cash at the end of the year. 3823. Look at cash. The overdraft is 0. The other amount is 3823. So this is correct. 3823. 3823. You can see 3823. 3823. The other one is an overdraft of 9322. Overdraft of 9322. Here we got 9323. So there's a difference of 1 for the cash flow that you've prepared for the year ended 30th June 2021. So this is how you are supposed to deal with this question on preparation of the statement of cash flows, of course using Excel. The same thing that you know, but can you do it using Excel? That is the big question. Can you do the same thing using Excel? And if you can, then it means that you can be able to prepare a statement of cash flows. In our subsequent classes, we are going to look at other questions that were in that pilot paper, more specifically the question 21 on section 2, which required us to prepare a spreadsheet showing the forecast statement of profit or loss for the year, for the next 3 years under, of course, each of the 3 scenarios. But that will come later. For now, I would like you to comprehend this and see if you are able to repeat whatever happened here. Bye for now. and see you in our next session.
Agricultural credit policy. Agricultural credit policy. Candidates, investment in the agricultural sector, just like any other sector, requires finances, requires heavy financing. To improve production of crops, to improve production in animal rearing, there has to be investment in inputs. There has to be investment in farm equipment. There has to be investment in farm services, and that can be quite expensive to citizens in developing countries. So the objective of the agricultural credit policy is to make adequate investment funds available to the agricultural sector at the right time and at such rates as will make returns from agriculture more attractive than before. There has to be a policy. What will be the purpose of this policy? I repeat, the objective of agricultural credit policy is to make adequate investment funds available to the farmers. And that investment should be timely. Such funds should be affordable. The rates should be ones that enable farmers to make returns. The rate should be one that makes farmers to make returns, which in turn will make it more attractive than before. And that may include candidates, the structural adjustment in fiscal and monetary policies. Why? Because the fiscal and the monetary policies affect the agricultural sector. So an agricultural credit policy could just be part of the monetary policy of a country. It may also involve just changes in the operation of existing institutions that are set up to provide agricultural loans. Because here we are discussing credit, loans, money. Okay? So agricultural credit policy can be what I may call a two-ranged policy approach. Two-ranged policy approach. One is change in the fiscal and monetary policy. One could be change in the existing institutions that are set up to provide agricultural loans. Do you understand, candidates? We are discussing a common problem in developing countries. If you hail from developing countries, then you also could be aware that farmers in developing countries have challenges. These challenges we discussed in our last lesson. In our today's lesson, we are looking at ways in which the government can come up with policies to improve the agricultural sector. Improving agricultural sector means stepping up the production of crops and rearing of animals. So the third policy is sectoral policies. Through sectoral policies, then the agricultural sector can be improved. Candidates, the policies within the agricultural sector, such as trade duties, such as subsidies, such as what we call parastatal margin scans, can mitigate or exacerbate the implicit taxation that is caused by the general economic policies. Right? Sectoral policies can improve the agricultural sector. Then there is mechanization policy. Number 4, mechanization policy. There should be guidelines on automation or mechanization. The main objective of the mechanization policy candidates is to reduce what we call the drudgery of agriculture by providing mechanical power to replace some of the labor required in the agricultural business. In developing countries, we've seen farmers using outdated technologies in production of crops, production of animals. The government should put in place a mechanization policy whose objective is to reduce drudgery that is caused by outdated old technology in the agricultural sector. It is also the objective of this policy to reduce the high cost of agricultural production, which arises largely from high labor wage and high share of labor cost in the total cost of agricultural production. So those are two objectives of this mechanization policy. When machines replace the labor-intensive sector of agriculture, then the cost of labor goes down. When the cost of labor goes down, then the total production, agricultural production also reduces. When the total production reduces, then the prices of agricultural commodities also are reduced. When the price of agricultural products are reduced, then the demand is increased. The demand is increased because there are some customers who do not take certain agricultural products because of the prices. So mechanization can bring down the general price of the agricultural products, and when that happens, then we say that is an improvement in the agricultural sector. Because again, remember, we live in a global village where countries that are developing, countries that are already developed are competing for in the same market. So when products, agricultural products from the developing countries are highly priced, then over time such products will be we cannot compete in the market, especially from products from developed countries where mechanization has been perfected. Number 5, procurement and support prices policy. Procurement and support prices policy. Another policy candidate here is a policy that measures the significant importance in the procurement and support prices to ensure fair returns to the farmers, so that even in the years of surplus, the prices do not tumble down and farmers do not suffer losses. This is a policy of significant measure. All right? And it is necessary to ensure that farmers are not penalized for producing more. Because candidates are times when certain agricultural products are produced in excess. When there is excess supply of certain products in the market, then the suppliers or producers of such products are likely to suffer loss because of the surplus. Because excess surplus or supply of a commodity in the market brings down the prices. So there should be a policy in place to support farmers when it comes to the area of pricing. It is necessary so that farmers are not punished for producing more. In fact, we need to have something like, say, a commission, policy of, say, commission for agricultural costs and prices. Such a policy helps to price products fairly, so that such pricing can be an incentive to farmers to expand production. Farmers should not fear producing more because of the excess demand. There has to be a policy in place to support prices of commodities in the market. So procurement and support prices policy can help improve the agricultural sector. Economy-wide policy, number 6, economy-wide policies. Economy-wide policies. Policies in areas like, say, trade, exchange rate, fiscal policies, monetary policies have a significant impact on agriculture in developing countries. So such policies, candidates, are leading determinants of the movement of capital and labor between agriculture and the rest of the economy, all right, including the growth and also the composition of agricultural output and the volume and the composition of trade in agricultural products. So economy-wide policies can improve the agricultural sector. Policies in trade, policies in exchange rates, policies in fiscal, and also the monetary policies, I've said they have a significant effect on agriculture, especially in developing countries, because the policies are leading determinants of movement of capital. When the government changes its monetary policies, which we will be discussing in this topic, we will be looking at monetary policy, the objective of monetary policy. We also discuss the ways in which monetary policy can be implemented in this lesson. So we're saying, candidates, when a government changes monetary policy, that has an effect on movement of capital. That may have an effect on movement of labor. That is within agriculture and the rest of the economy. So the government can change monetary policy, can change fiscal policy, can change policy on exchange rates, can change policy on trade, with the view of improving the agricultural sector. So candidates, these are 6 policies I've discussed in our today's session. And on that note, we bring the lesson to a close. But before we end the lesson, here is one assignment. One question: examine 5 policies that can be implemented to improve the agricultural sector in developing countries. Please, when answering the question, avoid referring directly to the notes. Try and see if you can recall what you have learned in today's lesson from your memory. Thank you. God bless you. In our next session, we are going to study the role of industry in economic development.
Hello Lana, welcome to Manifested e-learning platform. My name is F.A.M. Ningwiri, and today, ladies and gentlemen, we are discussing about the business data analytics, December 2023, question 22. It reads as follows: Safari Limited is evaluating a project with the following details. You've been given the initial investment, 100 million, residual value, 10 million, year one projected project cash flows is 25 million, the annual cash flow growth rate from year 2 is 10 million, the project life is 5 years. You are required: A, compute the following project metrics: payback period, number 1, number 2, the net present value, assume a discount rate of 12%, number 3, the profitability index, assume a discount rate of 12%. B, using a graph, determine the project's internal rate of return, and this totals 30 marks. So trying to answer this question gives us or gives you 30 marks there in total. So to start us off, we are first of all going to do the following. We're just going to first of all come right here and we say we have the year given to us over here. Given to us over here. And this solution over here, I can just drag this one down over here. This is A, and this gives us year. So we have the years given to us. They're from year 0, 1, 2, and of course you know what happens. Once you put it like this and then you have that plus sign like that, you can drag it up to the number of years you actually want, like that. So let's assume it goes all the way to year 5. Not assume, we've been told it goes to actually to year 5. And you can be able to see the project life right over here is 5 years. So from year 0. And we are saying from there, then we need then to put the value over here. We're dealing with Kenya shillings. So shillings, put shillings. And we are saying we can put them in thousands. That. All of these need to be put in terms of thousands over here. That. Why? Because we're dealing with thousands. We just do not want to deal with very big figures like that. We just want to deal at least with manageable figures. And from there, we can put over here the initial investment. That. Then we can put the initial investment right here as 100,000. Why am I putting 100,000? Guys, because you're saying that we are expressing it in terms of thousands over here. Yes, it's 100 million, but if you remove those 3 zeros there, we're saying we're dealing with 100,000. And because we want to deal with values that are in terms of the accounting format, so let's put it like that, then just do it sort of something like that. That looks at least well presentable, I mean. So initial investment is that. Then we have the residue value or residual value. That. And the residual value is assuming that you sell the asset at the end of the project or after 5 years there. So right here I can put over here in terms of the residue value, you can put 10,000 here. You sell an asset and you realize 10,000 in terms of value. Once that happens, then we can move ahead and look at the values over here in terms of the net cash flows over here, the cash flows. Cash flows. And you're saying the cash flows over here we've been given, the initial investment is 100 million. You're saying the project 1 cash flows is 25 million over here. So assuming that this is, of course, is the initial investment. We can put a negative value over here like this. We're saying that we can be able to put, so it's negative, I just sort of put negative, enter. It can be able to appear, and that it's an outflow. We can put the values over here as follows. For year 1, we're saying is 25,000. Not right there. You can put, because this is the residual value, the cash flows here, 25,000. That. And we're saying this 25 million or 25,000 over here, in our case here, is going to grow at an annual rate of 10% from year 2. So from here, we can do sort of something like so. We add that value and multiply it by a factor of 10%. So times 1.1. That. We get 27,500. Then we just drag it, because this has got a formula. We drag it sort of like that. And we make sure at least it auto fits within the cells. So from there, we are saying that what is going to be our net cash flows? Our net cash flows are going to be as follows. Flows. Then, so here we're going to pick this value here. The ones we're going to discount, these ones are going to use this value here. And then we are saying we're going to use, we're just going to pick the residual value plus the cash flow itself over here, if any. So that now it, after period 5, we expect this cash flow to be 46,603 over here to be the cash flow you're going to discount back to period 0. So we drag it and it picks. You can see now these are the cash flows you're going to discount over here. You can put them in bold, Control B. That, of course, we can be able to expand it by sort of clicking, double clicking like that. Those are the cash flows. Once we have that, we can then get the payback period. So over here I can write now the payback period. Because that's what you're looking for, payback period. This means that we need to get the cumulative. Cumulative values. I can be able to just put it sort of like that. And we come right here and put it maybe in form of a box like that. So that's what you're interested in, the cumulative cash flows. So here, it's just going to be that value. And then we're going to pick plus that value plus this net cash flow here. Comes to 75. And then we reduce it. We continue. We drag it because it's just got a formula. We continue up to there. But if we continue over here, if we get 33,000, we subtract, because of or 17,000, we subtract 33,000, we should be able to get a positive value. What the payback period tries to measure is how much you can be able to recoup this original investment of ours over here of 100,000. So clearly over here we'll be able to get a positive cash flow, yes. But in terms of the payback period, in terms of years, you can see the number of years given to us right here. We can say that the payback period, so payback period over here will be given to us right over here. So this is year 1. We can say year 1, indeed, we're still getting a negative cash flow. Here, year 2, we're still getting a negative cash flow. Year 3, we're still getting a negative cash flow over here. But when we reach year 4, we are going to get a positive cash flow. This, let me just demonstrate. We're just going to get a positive cash flow over here like so. And that's not what we want. We want to recoup this original investment. We do not want a positive cash flow. We want to see the exact number of years we're able to recoup this 100,000 right here. So just delete that. We know it is going to be 3 years, but 3 years and how many months? So we can be able to put the number of months right over here, or we can be able to compute it right here. So it's going to be that value over this value, and then we multiply by 12 because we want it in terms of months. like that. So 6.22 months. So the payback period you can see is, we can say, is here. Payback period is 3 years, 6.22 months. That is what answers our first part right here, the payback period. So we can move ahead to part B, the question over here. And part B, we can just go down right here. B. It's a similar fashion or a similar format. We are looking for the net present value right here at a discount rate of 12%. So net present value. Net present value. And we're saying the net present value is, just given, is just how much we are able to get. Are we going to realize a positive cash flow or a negative cash flow based on discounting? You're using a discounted cash flow technique so that you can be able to get the present values. And in a similar way over here, so we're not in B, we're doing part A, part 1. So this is A, part 1. I can just put it like so. This is A, part 2. A, part 2. Like that. So that now we can be consistent there. And to get the net present value, what we'll need to do, if you allow me to copy this over here like this, cash flow, the cash flows over here, I can be able just to copy these ones the way they are like that. Copy, just put them just down here. So, and of course, I'll be able to also copy this. Allow me to copy this. Copy, put it just down here like so. And this I can drag it maybe down. I can just drag it somewhere down there like that. So the initial investment, we pick it from above here. That's the initial investment there. No problem. The residual value, we just pick this from above here. And then we're saying the cash flows, we're just going to pick whatever we have right above here. So we're linking it like that. And we're saying these cash flows are the ones which we will need then to discount. So this is how we're going to discount it. So the net cash flows, we still pick them from above there. Net cash flows like that. And then we have this value like that. And this is what we're going to discount. These ones over here. These net cash flows. You see, like the way I've did over here, the relevant values, these are the ones which are we're going to discount and get the present values right over here. So present values. So the present values will be, we're going to get this value over 1 plus r over here. But for us to be able to get the present values, or in Excel, there's always a way we can be able to get the present values. Always. There's always a way how we can be able to do it. And we can just say the NPV. Instead of discounting this value over 1 plus the discount rate power 1, this value over 1 plus the discount rate power 2, power 3, power 4, and power 5 like that, we can just go to the to a formula NPV like that, and we are saying we open it up right here, and we can see the rate. The rate is just 12%. And once we have the rate as 12%, under the value 1 here, we put in those cumulative cash flows like that. And then we will need then to subtract the initial cash outlay. So would it be correct for me to add right over here? We add the initial cash outlay there, like that. That's the initial cash outlay. So that's what we are saying we are going to have. 13 million, of course, because we're dealing with millions. 13,365,99. That is what you're saying represents NPV. And so you can maybe highlight the answers maybe in red like that, so that you can be able to know that these are the answers. We can move on and discuss about the profitability index. The NPV, before we move on to the profitability index, the NPV is the net of present values to try and see whether you're able to get a positive cash flow or a positive value or a negative value. If NPV is positive like this, we accept the project because the project is going to yield us positive values in future. But if you get a negative NPV, then it doesn't make any sense to us here. So here, part 3, I can move ahead right down here and now click this one to be 3, the third one. That. A, part 3. We talk about profitability index. That. Under profitability index, we are going to get the present value of cash flows divided by the initial cash outlay. That gives us the profitability index. Any number greater than 1 gives us positive, or we are supposed to go ahead and invest in that project. If it gives us anything less than 1, then we reject the project. And we are told to assume the discount rate of 12%. So what we do is that we just go ahead and use the similar values right over here. Copy. We come right here, or rather I should have copied from here, sorry. Copy, and you put it right maybe just down here. Paste special, we want to paste special formulas and all. Oh, it's refusing, so we just look for an alternative way, put it like that. So with these values, we can just link it with the first value right over here. So just link it with that one, that, and we can just drag it moving across like that. The residual value picks from here, that. So these represent the net cash flows. So this is what we're saying is shillings, so we just delete this and it's okay. But the initial investment picks from here, the net cash flows, that value there. So once we have that, then we can be able to get the profitability index. And the profitability index, we are going to get the present value of cash flows divided by the initial divided by the initial cash outlay. So we're going to use NPV rate 12%. The values, we are saying we're going to use these values here. And there's one thing that we needed to change here. We need to add the two values, these two values here, before we continue. That one plus that one there. See the profitability index, NPV See here, double click it, then we open it up right here, and you see the rate is 12%. And then with 12%, we can put in the values over here, like that. We are getting that value, the present value of cash flows, and we are going to divide this against the initial cash outlay. So minus, open the brackets, this one. Enter. That's what we get as our profitability index, 1.13. So in this case, we accept this one based on NPV, we accept, and the payback period, if it's the shorter the payback period, the better it is for us. So here, just like for consistency purposes, we put it in red like that. And we can see that we're moving on well, and we now move on to part B of the question. Using a graph, determine the project's internal rate of return. The project's internal rate of return is at the point where you get, the NPV is equals to 0. Where the NPV is equals to 0 is where we are saying our project's IRR is going to be. And so we're going to use a graph. So first of all, you're going to test it using the IRR formula. So IRR, or internal rate of return. Rate of return. The internal rate of return, IRR, is going to be, we open it up right over here, the values. So we put the values right over here, all of the values, including the negative value here. And we say, okay. So it's around 17%. And that's what we expect, or 16.75%. That's what we expect from using the graph, around thereabout. So we pick arbitrary rates, so 12%. You can put 12% over here, 13%, like that, and so on and so forth like that. So we just drag it. So we can just get arbitrary rates over here, and we get the corresponding NPVs. So NPV over here, 12%. The rate is 12%. You can see from right over here, 12%. The values over here are these ones here, the net cash flows here, like that. And then we do what? We add the initial cash outlay. The initial cash outlay in this case was negative here, that, and we get that value. So it's the same as what we got above over here. That's fine. But because we want to ensure that we want to get the corresponding NPVs at different rates over here, I need to lock the formulas over here. So I press F4 there. I click over here, I press F4, and I press F4 over here, so that I can be able to lock and ensure that everything is okay. So if I drag my formula over here, it should be able to work. So that's what I'm going to do right here. So shift, Control D. But it's picking 13%, or it's because I didn't change. You see, it's still at 12% here. So what I'll do, I'll just change this to 13%, 14%, like that, 14%, 15%, and so on and so forth. Just come and change here, 16%, around 17. That then 18. So don't worry about that. 19. Then here we got 20%. 20%. Like that. So you plot a graph over here. This is the NPV. NPV, that rate. Like that. So just sort of put it center to make it look presentable, and like that. Then you can just draw a graph here. Insert. Then you come to recommended charts, and you can be able to see, based on this graph over here, that point, okay, just place it somewhere right here, that at around 16% over here, you can see at around this point here, if you click right here, it will give you the point. At around 17% is when you're going to get negative NPV thereabout. 17%. And you can see it's 16.75 right here. So the exact rate should actually be somewhere over here where it's next to. It's along just this curve over here. It cuts it along this axis over here like that. NPV indeed is at 16.75. So once you draw the graph like this, it should be able to, and then you just highlight like this, you can be able to see thereabouts around approximately 17%. You can be able to get the IRR. So ladies and gentlemen, this brings us to the end of the class. We have done question 22 of the Business and Data Analytics paper, which came in December 2023. Hope you have enjoyed it. God bless you all. Bye-bye.
Hi candidates, welcome to another session of Manifested Online Classes. In this session, I want us to continue with the topic of analyzing the financial statement, which is topic 7, and the last topic in FRA. So in this session specifically, I want us we do an illustration question, and the question I want us we do is the question which was tested in the sitting for 2021, specifically question number 3. Let's go through the question and we see what was required. So question 3 of 2021, December 2021 reads, various analytical tools are today utilized in financial statement analysis. Some of these tools include number 1, ratio analysis, number 2, trade analysis, and number 3, common size financial statement. Required in context of the statement above, describe how each of the above tool is utilized in practice. So we are given the various analytical tools, and what the examiner there was requiring is we describe, or basically we explain how those particular tools are used in what? In practice. So this is part A, which require explanation of various analytical tools, or we can just talk of explanation of financial statement analysis tools. So in that case, you're given a number of tools which are required to explain. The first one is ratio analysis. And for the ratio analysis, this particular tool here or technique, it basically entails computing various financial ratios. And in our case, we know a financial ratio is a relationship between two or more financial variables. So therefore, you can say this entails computation of financial ratios. financial ratios, and also we have various categories of ratios which we discussed in our first session as far as this topic is concerned. So the other tool we are required to explain is the trade analysis, which is also known as the horizontal analysis. Now, horizontal analysis, which is also known as a trade analysis, is basically analysis which is done or undertaken by a financial analyst to establish the trade, or in other terms, to establish the change, which is the increase or decrease of the various financial statement items as compared to a certain base period. So therefore, you can say that this entails establishing the trade. So in this case, the trade is the same with the change, and this change can either be an increase stroke decrease, decrease of various financial statement items, in a certain financial period or in a certain year, as compared to a base period, as compared to a base period. For example, in this case, you can be given the income statement which was prepared by the company in the year 2023. You are given various items of the income statement. For example, maybe you can just pick one, and that is revenue. You're given the revenue of the company for this year. But equally, let's assume that you're given the revenue for 2 years, not 1 year, revenue for 2 years, 2022 and 2023. So in doing this particular analysis here, which is known as the trade or the horizontal analysis, we are saying what we need to do is to establish the trade, or basically the change, that is the increase or decrease of financial statement items in a certain year compared to a certain base period. So what we do here, assuming you're given the revenue here to be 200 million, here to be 250 million. So we have an additional column here whereby we show the increase stroke the decrease, stroke decrease, and this increase or decrease will be for the most recent financial year, which is now the year 2023. And in this case, we can see the revenue for this year increased with 50 million compared now to the revenue for this year. So basically what that means is that the year 2022 will be recognized as the base period. That is the year we are using to determine whether the revenue for 2023 increased or did what? Reduced. After showing the increase or decrease, basically an increase you record it as a negative, but if it was a decrease recorded as a negative, it must be inside the bracket. And then finally, you have to express that increase or decrease as a percentage. You express that increase or decrease as what? As a percentage. For example, in this case, you take 50 million, divide that with the revenue for the base period, which is the 200 million times 100. And in this case, we can make a conclusion that the revenue for this year increased with 25% as compared to the revenue for 2022. That is now what we refer as the horizontal or the trade analysis. And basically, you repeat the entire process for all the items of the financial statement. So then we also require to explain the other tool number 3, common size financial statement. Common size financial statement. These are financial statements which are prepared by expressing all items in the financial statement as a percentage of a certain base item. So here, all items will be expressed as a percentage. So we can say this entails expressing all items in financial statements as a percentage of a certain base item, as a percentage of a certain base item. And here we have number one, the common size income statement. So common size income statement, this one, entails we express all items in the income statement as a percentage of revenue. So all the items in the income statement here will be converted, or basically will be expressed as a percentage of the revenue, or basically as a percentage of what? Of sales. As a percentage of sales. And then we have the common size statement of financial position. This one entails, or this one is prepared by expressing all items as a percentage of total assets. As a percentage of total asset. So therefore, that's what you mean by common size financial what? Statement. And that's what was required as far as Roman 1 of that question is concerned. And the marks which were located there were 6. So basically what that means that explaining each of these you are getting 2 marks. 2 marks for explaining each of those particular what? Concept or those particular analytical tools. So let's move to part B of that question, and it reads, summarize 4 attributes of a good financial statement analysis. So the examiner here was asking about the attribute, or in other terms, the qualities of a good financial statement analysis. So let's explain those attributes. Attributes of a good financial statement analysis. So these are, in other terms, are qualities of a good financial statement analysis. And I think in our previous session we discussed on this. We have around maybe 5. We can talk of number 1, timeliness. Timeliness. And in this case, we say that the information which is provided by financial analysts, it has to be provided on time to help the users in terms of making decision. Number 2, we have understandability. Understandability. Equally, the information provided by financial analysts must be readily understandable by the users for the users to use that information in terms of making their intended decision. Then we also talked about the reliability, and we said this information provided by financial analyst, one, must be complete. It must be what? Free from any errors, and also it must be what? Neutral. We also have relevance, meaning that the information provided by financial analyst must influence the decision which will be made by the users. Must influence the decision which will be made by who? By the users, and so on. So I think the examiner there was just requiring 4. We can just talk of those particular 4 attributes, and equally the marks which were located there were for basically for explaining it. You get those particular or for explaining those 4 attributes, you get a total of 4 marks. So let's move to part C of that question, and it reads, the following are extract from financial statement of financial statement from the books of Zawadi Limited. We are given the extract of the income statement for 2 years, 2020-2021. We are given the sales revenue. We are given the cost of sales, which are told approximate purchases. We have the gross profit, administrative expenses, distribution cost, profit, or we have the finance cost. Then we have the profit before tax. We have the extract of a statement of financial position, where we have non-current asset, which include property, plant and equipment, intangible assets. Current asset comprises of inventories, trade receivables, cash and cash equivalent, and then we have the total asset. We have then the current liabilities, which include trade payables, current tax payable, and then we have the total current liabilities. Then we are told to assume a 365 days financial year, From that information, the examiner was requiring we analyze and interpret the performance and efficiency of the company for the 2 years, the year which ended 30th April 2020 and 2021, using the following ratios. So in other terms, what the examiner was requiring is we compute those 5 ratios and we comment on the company's performance and efficiency over the period of 2 years, that is 2020 and 2021. So therefore, let's compute those ratios. This is part C of our question, whereby we are required to compute a number of financial ratios, and we are required to compute those ratios for 2 years. For 2 years. So we need to have like 3 columns here. The first column will be for the ratios we are expected to compute. Then we have our 2 financial years. We have 2020 and 2021. So always make sure the first year comes first for you to be able to see the trend. So the first ratio we are expected to compute is the gross profit margin. Gross profit margin. So the first thing you have to recall here is the formula. How do we compute this? We take a gross profit, we divide that with the revenue times 100. So that's how we compute that ratio. So we go back to the income statement or the statement of profit or loss. This is where we get the information about revenue and the gross profit, actually from the income statement. So the gross profit for the first year is 103,812. We divide that with the revenue, which is 476,200 times 100%. And then for the other year here, we have the gross profit, which is 117,902, divided that with the revenue, which is 701,800, and we definitely have to multiply that with what? With 100. So let's compute these 2 ratios here. We see what we are going to get. So the ratio for the first year is 103,812 divided by 476,200 times 100%, and that will give us 21.8%. What about 2021? We have 117,902 divided by 701,800 times 100%. That is giving us 16.8%. So let's move to the other ratio, number 2. Number 2, or Roman 2, we are required to compute the other ratio, which is return on capital employed, or LOCE. Roman 2, return on capital employed. This one is computed by taking, we compute this by taking PBIT, profit before interest and tax. We divide that with capital employed times 100. In terms of how we compute the capital employed, this one is computed by taking the total asset minus current liabilities, or alternatively you can take equity plus non-current what? Liabilities. So, but let first of all we get the profit before tax. The profit before tax, in other terms, is also known as operating profit. You get that from the income what? Statement. But in most of the cases, the examiner will not have given you this. Like if you check on the information which you are given in the income statement, there is nowhere we are given the profit before what? Interest and tax. So what we are given by the examiner is the profit before tax. So how do we arrive at the profit before interest and tax? So we take this profit before tax and then we add interest. The interest is the same with the finance what? Cost. After adding the 2 figures, we are going to have the profit before interest and tax. So let's do that. We take the profit before tax, 50,850, and then we add back interest, or the finance cost for that year is 7,200. That now will give us the profit before interest and tax. We divide that with the capital employed. The capital employed, I've said, you can take the total assets minus current liabilities. And actually, that is a formula we are going to apply here. We take total assets. Total asset will be equal to non-current asset plus current asset, which is 10, 18, 140, plus current assets. Current asset 236, 695, and then to this we less current liabilities. Current liabilities is 179, 835. That's how we are going to arrive at the figure for capital employed. So we do the same for 2021. We take the profit before tax, which is 42, 960. We add the finance costs or the interest, which is 10,800, and then we multiply that with 100. We divide that with the capital employed, which will be equal to total non-current asset 1881, 500, plus current assets, which is 335, 500, minus current liabilities 297,000. 297,000. Yes. So this ratio is very, very common because you can see none of these two items, the profit before interest and tax and capital employed, is provided to you by the examiner. You have to remember the formula for computing those two items. So let's compute those two, or basically compute the return on capital employed for the 2 years. So we start with the first year here. We have 50, 850 plus 7,200. That will give us 58. We can write it here, 58,050. And then we have the denominator 10, 18, 140 plus 236, 695 minus 179, 835. 835. So that will give us 107. Okay. So what we need to do, we take 58,050 divided by answer times 100%, and that will give us a 5.4%. What about the other year here? We have 42,960 plus 10,800, that is, and then we divide that with 1881, 500 plus 335, 500 minus 297, 1,000 times 100. That will give us 2.8%. 2.8%. So that's how we compute that figure for what? For the return on the return on capital employed. So let's move to the other ratio, number 3. Number 3, we have inventory turnover period. Inventory turnover period. So the inventory turnover period, this is a ratio generally which is computed to determine on average the number of days this company was taking to convert inventory into sales. So how do we arrive at this? So we take the average inventory, we divide that with the cost of sales, and then we multiply that with the number of days in a year. So in our case, we are told to assume a year has 365 days. So how do we compute the average inventory? So we compute the average inventory by taking the opening inventory plus the closing inventory divided by 2. But we only compute if you're given a question and you're given 2 financial years like what you're given here, 2020, 2021, you only use the average figures if the examiner has provided you information or has given you the opening inventory for the first year. If you're not given that opening inventory, then for the 2 years, you use now your closing inventory as your average. So meaning that you only compute now the average in the event you're given the opening inventory for the first year. If it's not given for the 2 years, then use your closing inventory as your average. So we have the closing inventory under the current asset. In the first year, it is 81,000 times 365. And then the other year here we have 81,400 times 365. And then we need to divide that with the cost of sales. Cost of sales, we get that from the income statement. We have 372, 388 for the first year. And here it is 583, 898. So let's compute this particular ratio here. So for the first year, we have 81,000 divided by 372, 388 times 365. So that to the nearest whole number will give us 79 days. 79 days. What about the first year? 81,400 divided by 583, 898 times 365. That to the nearest whole number will give us 51 days. So these are ratio computed to show on average the number of days the company was taking to do what? To make sales or to convert inventory into sales. So the other ratio, which is number 4, as the trade receivables correction period. So how do we compute this particular ratio here? So we take the average trade receivables, we divide that with the credit sales or the credit revenue. We multiply that with this 365 what? 365 days. And equally here to compute, to determine the average trade receivables, we take the opening trade receivables plus the closing trade receivables divided that with 2. But equally, we only compute the average in the event the examiner has given you the opening receivables for the first year. So in such a case whereby you're given 2 years. But if you're not given the opening receivables for the first year, what you do, you then use the figures in the statement of financial position as your average. That will be the case in year 1 and also year 2. So where do we have the receivables? The receivables, we have them in the statement of financial position, specifically other current assets. So for the first year, we have 95, 240. We multiply that with 365. The same case with the other year. 175, 450 times 3 what? 65 times 365 times 365. We divide that with the credit sales or the credit revenue. Equally, if you check on the income statement, what the examiner has given us is revenue. And unless told otherwise, always you use the revenue in the income statement to be on credit. To be on what? Credit. There are some cases whereby the examiner may have given some information that the revenue of the company was 70% of the total revenue. Unless such information is given, you assume the entire revenue was on credit. So the credit revenue for the first year is 476,200. For this year, it is 701,800. So we compute these particular ratios and we get the final figure. So let's start with the first year, which is 95, 240 divided by 476, 200 times 365. So this will give us 73 days. And then in the first year we have 175, 450 divided by 701, 800 times 365, which will give us 91 days. 91 days. Yes, so that is it, that what is required there. And then finally we have the other issue, that is the trade payables payment period. Okay, so let's just have it here. Trade payables payment period. So how do we compute this one? We take the average trade payables times the number of days in a year, 365, and then we divide that with the credit purchases. Credit purchases. In the event the examiner has not given you the credit purchases, what you do, you instead use now the cost of sales. But if you take on what you're given in this question, we are told in the income statement the purchases, or basically the purchases of the company were the same with the cost of sales. So therefore, let's compute this ratio. So we take the average trade payables. Average trade payables equally, we take the trade payables at the start plus the closing, and then divide that with 2. But equally, the concept I've explained here, for receivables, for inventory, we only compute the average trade payables where the examiner has given you the opening payables for the first year. If that is not given, then in year 1, year 2, use the figures in the statement of financial position as your average. We know trade payables is part of the current liability. So this is 111, 715 times 365. Here we have 204, 365 times 365, and then we divide this with the cost of sales or the purchases, which is 372, 388, and then here we have what? We have 583, 898, and then we get the final answers here. Yes, so let's compute those final answers. We start with the year 2020. We have 111, 7115 divided by 372, 388 times 365. So that will give us 109 days. 109 days. And then finally we have 204, 365 times 365 days divided by 583, 898. So this will give us 128 days. 128 days. Yes, so that is it, that basically what was required as far as that question is concerned. And by computing those particular ratios, for each ratio the examiner was had allocated 2 marks. So meaning that by doing that you get 2 marks, 2 marks, 2 marks here, and equally there you get what? 2 marks. In total there were 8 what? There were 8 marks for computing those ratios. But you can see, as far as the computation of ratios is concerned, what is important is for you to remember the formulas. If you can't be able to remember the formula for computing these ratios, then there is no way you can be able to successfully attempt and also pass a question on computation of what? Of ratios. So that is it, that what was required as far as that question is concerned. I want to give an assignment which I expect you to attempt, and the question or the assignment is a question which was tested in the April of 2022, specifically question number 2. Question number 2. This is a question which was requiring the computation of what? The computation of ratios. The computation of ratios. Once you attempt that question, I usually encourage all my students to get these revision partners by manifested publishers, is updated up to the latest sitting. So therefore get this. Once you attempt the question, you have any challenge in terms of answering that question, you'll be in a position to access all the solutions at the end of this particular book. So therefore, make sure you also have this particular revision kit with you. So that brings us to the end of that particular session. So once we come back in our next session, I want us to look on an illustration question which was tested in the sitting of August 2022, which was requiring the preparation of the common size financial statement. Hi candidate, welcome to another session of Manifested Online Classes. So in this particular session, I want us to look on an illustration question on analysis of financial statement. And the question I want us to go through is the question which was tested in the sitting of August of 2022, specifically question number 5B. So the question reads, Dragon Limited is a public entity which has grown in recent years by acquiring established business entities. The directors of Dragon Limited have identified two potential entities targeted for a takeover. The directors believe that shareholders of the two target company would be recipient to a takeover. As a prerequisite to the takeover decision, the directors have tasked a firm of consultants to carry out cross-sectional analysis of the financial statement of the potential target companies which operate in the same industry sector. The financial statements of two entities as at 30th April 2022 are shown below. We have the statement of profit or loss for the year which ended 30th of April 2022 for two companies, Able Limited and Cedar Limited. We have revenue, cost of sales, gross profit, distribution cost, admin expenses, operating profit, finance cost, profit before tax, income tax expense, and then we have the profit for the year. We also have the statement of financial position as at 30th of April 2022 for Able and Cedar Limited. We have the non-current asset which include property, owned plant, right of use asset. At the current asset we have inventory, trade receivables, bank total assets, and then we have equity which comprises of ordinary share capital, evaluation reserve, retained earnings, and then we have the total equity. At the non-current liabilities we have the lease liability, 10% loan notes, and then we have current liabilities which comprises of trade payables, lease liability, current tax, and then we have the total equity and liabilities. What is required in Roman 1 of that question is common size statement of profit or loss for the two entities for the year which ended 30th April 2022. Roman 2 common size statement of financial position as at 30th April 2022. And finally, we are required to advise the directors of Dragon Limited on the best company for the takeover. So let's start with the Roman 1 of that particular question, whereby the examiner was requiring we prepare common size statement of profit or loss, statement of profit or loss for the two entities, which is for the year which ended 30th of April 2022. Remember, when talk about the common size, a statement of profit or loss, this is prepared by expressing all items in the income statement or the statement of profit or loss as a percentage of total asset. So not the total asset, but rather the revenue or the total what? Revenue. We are going to express all items as a percentage of the revenue. And take into account we have two companies. We also need to have two columns here. The first column will be for the company which is called Able Limited, and the other one will be for the company which is called Cedar. So what we do, we express all those items in the income statement as a percentage of revenue. So revenue as a percentage of itself is always 100%. This one is 100% because what we do, we take the revenue, for example, for Able, 87,500, then the denominator here will be the revenue. So 87,500 times what? Times 100, times 100. So that is always 100%. Then we have the cost of sales. So to express the cost of sales as a percentage of revenue, we take the cost of sales 66,500 divided that with the revenue for that company which is able 87,500 times 100. That is for the first company. For the other company which is CEDA, we are going to do the same. Take its cost of sales 114,800, divide that with the revenue for CEDA Limited times what? Times 100, times 100. So let's compute this. We see what we are going to get here. We see what we're going to have. So we have 66,500 divided by 87,500 times 100. That will give us 76%. 76%. What about the other company? Okay, so I think first of all we can deal with the ABLE, whereby we are going to express all items in the income statement of ABLE Limited as a percentage of what? Of revenue. So let's go to the gross profit. Gross profit. So the gross profit in this case is 21,000 divided by revenue 87,500 times 100. This will give us 24%. What about the other item, which is the distribution cost? Distribution costs. So the distribution cost is a figure of what? Is a figure of 1495 divided by 87,500 times 100%. That will give us 1.78%. Then we have the administrative expenses. The administrative expenses, which is 2880 divided by revenue 87,500 times 100, which will give us 3.29%. Then we have the operating profit. Operating profit. And I hope you can see what I'm doing here. We are expressing everything as a percentage of revenue. You don't have to underline anything. You don't have to put anything. You don't have to show anything as a negative. You just show, you express all those items as a percentage of revenue, as a percentage of the company's revenue. So we have the operating profit, which will be 1625 divided by 87,500 times 100. So that will give us 19%. Then below that we have the finance cost. Finance cost. The finance cost in our case is 875 divided by 87,500 times 100, which will give us 1%. This is 1%. Then below that we have the profit before tax, which is a figure of 15,750 divided by 87,500 times 100%. Times 100%, which will give us, okay, let's take that again. We have what? We have 15,750 divided by 87,500 times 100, which will give us 18%. Then we have the income tax. So for the income tax is 3150 divided by 87,500 times 100, which will give us 3.6. And finally, we have the profit for the year. The profit for the year, 12,600 divided by 87,500 times 100. That will give us 14.4%. 0.4%. So we need to repeat the same process for the other company, that is Cedar. We express everything as a percentage of the revenue for Cedar. So we go to the cost of sales here, which is 114,800 divided that with revenue, which is 140 times 100. That will give us 82%. 82%. What about the gross profit? 25,200 divided by 140 times 100. This will give us 18%. Then we have the distribution, which is 2710 divided by 140 times 100, so which will give us 1.9%. Then below that we have the administrative expenses, 5340 divided by 140,000 times 100, which will give us 3.81%. Then from there we have the profit, the operating profit, 17,150 divided by 140,000 times 100, 12.25%. And then below that we have the finance costs, 3,150 divided by 140,000 times 100, which will give us 2.25%. Then we have the profit before tax, 14,000 divided by 140,000 times 100, which will give us 10%. Then we have the income tax, 3,500 divided by 140,000 times 100, which will give us 2.5%. And finally, we have the profit for the year, 10,500 divided by 140,000, which is 7.5. So that is what we refer as the common size statement of profit or loss. It is also important to note that from this common size statement of profit or loss, there are a number of ratios which you have already computed here, and which you can use in terms of evaluating which company is performing better than the other. So the first ratio which you have computed is what we have here, this one. Because in computing this, what we have done, we have taken the gross profit all over revenue times 100, and therefore this is a gross profit margin. A gross profit margin. So you can use that to compare the profitability of two companies, and going with the gross profit margin, we can say this company is profitable than Able is profitable than Cedar. We also have this other ratio here, which we have computed by taking the operating profit or the profit before interest and tax all over revenue times 100. So this is what we refer as operating profit margin. So equally, you can see, going with that ratio, profitability ratio, we can see this company is more profitable than Cedar. And also we have this other other ratio here, where we have taken profit after tax all over revenue times 100. So this is what we refer as a net profit margin. And equally, going with that, we can also see that this company here, that is Able, is more profitable than what? Cedar. In fact, we can make that particular conclusion here, that Able Limited is more profitable than what? Than Cedar. Limited. Remember, this particular information will help us in terms of advising the management of this company, which is Dragon Limited, on which company to acquire. Remember, we are told that Dragon Limited is targeting to acquire either Able or Cedar. So if in this case we are advising the management or we are advising the management on which company to acquire based on their profitability, automatically we are going to advise them to acquire which company? This company, that is Able, because you can see, as per these three profitability ratios, this company is more profitable than what? Than Cedar. So let's move to Roman 2 of that particular question. And Roman 2, what the examiner was requiring is the common size statement of financial position. Common size statement of financial position. And this one is basically prepared by expressing all items in the statement of financial position as a percentage of the total asset. Equally, you have to remember that the common size, this is also known as the vertical analysis. The vertical analysis statement of financial position. Statement of financial position. So here what we need to do is to express all items here as a percentage of total asset. We equally need to have two columns. We have Able Limited, and then we have Cedar Limited. We are going to express all items as a percentage of total asset, as a percentage of total assets. So we start with the non-current assets. We have property. Then we have owned property or owned plant. We have right of use asset, right of use assets, and then we have the current assets. So for the current asset, we have inventory, we have trade receivables, then we have bank, and then total assets. Total assets. So basically, total asset, because we have to express everything here as a percentage of total asset. Once we express total asset as a percentage of itself, that automatically give us 100 what? 100%. 100%. 100%. So we're going to compute all these particular items as a percentage of total asset. And then below that we have equity. Equity, we have ordinary share capital. We have retained. Okay, before that we have revaluation surplus. Revaluation surplus. We have retained earnings. Retained earnings, and then we have the total equity. Okay, so we can just ignore that. And then we have non-current liabilities, where we have the lease liability. And then we have 10% loan notes, 10% loan notes. And then from there we have current liabilities. We have current liabilities. For current liabilities, we have three. We have trade payables. We have lease liability. And then finally, we have current tax. And then we have the total equity and liabilities. Total equity and liabilities. And equally here, total equity and liabilities, this is the same with the total asset, and therefore once we express this as a percentage of total asset, automatically it will give us what? It will give us 100%. So therefore what we need to do, we need to express all these items in the statement of financial position as a percentage of total asset. So let's start with the property, and we start by doing that for the first company, which is Able. So we have 9,800 divided that with the total asset. Total asset as given as 33,600 times 100, which will give us 29.2%. And then for the other company here, okay, for the other item we have 7,000 divided by 33,600, which will give us 20.8. This company was not having any right of use asset. What about current asset? We start with the inventory, 5,600 divided by 33,600, which will give us 16.7%. Receivables, we have 7350 divided by 33600, which will give us 21.9%. And then we have the last item, which is not the last item, but the other item, which is 3850 divided by 33600, which is 11.5. 11.5. So we need to do the same to the other items of equity and liabilities. Let's start with the ordinary share capital, 3500 divided by 33600, which will give us 10.4%. 0.4%, and then we have 1750, which is the revaluation surplus divided by 33600, which will give us 5.2. Remember, here we're expressing everything as a percentage of total asset. What about the retained earnings? 5600 divided by 33600, which will give us 16.7%. What about the lease liability? This company was not having a lease liability. The company only had the 10% loan notes, which is 15,750 divided by 33,600, which will give us 46.9. Then from there we have current liabilities. So we have trade payables 4375 divided by 33,600, which will give us 13.0%. No lease liability. And finally we have tax 2625 divided by 33,600, which will give us 7.8%. So basically what we have done here, we have expressed all items as a percentage of total asset. We need to repeat the same exercise, the same process for the other company, which is CEDA. We compute everything as a percentage of total asset. Let's start with the property, which is 10,500 divided that with the total asset 66,500. This will give us 15.9%. The owned plant 8050 divided by 66,500, which is 12.1%. And then we have the right of use asset 17,500 divided by 66,500, which is 26.3%. We go to current asset. We start with the inventory 11,900 divided by 66,500, which will give us 17.9. Then from there we have 17, the other item of receivable 850 divided by 66,500, which is 26.8%. Then we have the last item, which is bank 700 divided by 66,500, which is 1.1%. 1.1. Okay, so we go to the items of equity. We have 7,000 divided by 66,500, which will give us 10.5%. Then we have revaluation surplus 150 divided by 66,500, which will give us 4.7%. Retained earnings, we have 9450 divided by 66,500, which will give us 14.2%. What about the lease liability? 14,700 divided by 66,500, which is 22.1%. And then the 10% loan notes, 17,500 divided by 66,500, which will give us 26.3%. We go to the current liabilities. We have trade payables, 7350 divided by 66,500, which will give us 11.1. 11.1. We have 2450 divided by 66,500, which will give us 3.7%. And then finally we have tax, 49 divided by 66,500, which will give us 7.4%. 0.4%, yes. So basically that is it, that what was required there. We have been able to express all items as a percentage of what? The total asset, as a percentage of total asset. And basically by doing all this, expressing these items as a percentage of total assets, basically by doing that you get how many marks? You get 5 marks. 5 marks. Marks. And equally for the first Roman 1 of this question, equally the marks which were located here were 5 marks. Were 5 what? 5 marks. And then from there we need to answer the last part of that question. The last part of that question. So we are told to advise the directors of Dragon Limited on the best company to acquire. Advice on best company to acquire. So between these two companies, that is Able and Cedar, which company should be acquired? Which company should be acquired? So for you to be able to, or for us to be able to give this particular advice, we base it on 2 aspects. One is the financial performance. And I think from the analysis which we did here, we said that the first company here, that is Able, this company is performing well based on these 3 ratios which we identified there. So based on the performance, the best company to acquire is what? Cedar. Number 2, you also have now to look on the financial stability of the company. So when checking on the financial stability of the company, you look on the extent to which the company is financed by the debt capital or by the borrowed capital. So therefore what you do, you come here and you check which company is financed by huge amount of debt capital. And basically in this case, when talk about the debt capital, I think we are talking of, I think just one here. This is the main form of debt capital, the 10% loan notes. Here we can be able to see that this company is 46.9 and this company is 26 point what? 0.3. Point what? 0.3. So therefore in this case equally we can be able to recommend that this company or the directors of Dragon to acquire which company? To acquire Able. So therefore you can say advice on the best company to acquire, we can say I will advise directors of Dragon Limited to acquire as Able Limited, since it is more profitable, it is more profitable than Cedar Limited. It is more profitable than what? Cedar Limited. Basically by giving that particular advice, you get how many marks? You get 2 marks. You get 2 marks. Yes. So basically that is it, that what was required as far as that particular question is concerned. And that is the only question which has been tested in this particular past papers for FRA regarding what if is the common size analysis. Equally, that brings us now to the end of that particular topic. And the topic was analysis of financial statement.
Greetings to you all and welcome to the lesson. The subject is fixed income investments analysis. Today we are going to answer question number 2 from the sitting that was done in December 2021. This was the first sitting after the revision of the syllabus in the year 2021. Question 2A reads, a financial analyst has been tasked with evaluating a floating rate security which has a quoted margin of 90 basis points and is selling for 99.2510 shillings and matures in 7 years. Required, Roman 1, the floaters spread for life, 3 marks. Roman 2, explain two limitations of the spread for life, 2 marks. First of all, we are going to take the first part, the floaters spread for life. Now, candidates, in the context of fixed income securities, the floater spread for life refers to the average difference in yield between a floating rate note and the benchmark interest rate it's tied to over the entire lifespan of the floating rate note. Here, candidates were to calculate the floaters spread for life. Floaters spread for life. Question 2A. Floaters spread for life. So first of all, you put down the formula. The formula for floaters spread for life is equal to 100 into 100 minus the price plus quoted margin times 100 over the price. So this we multiply by that. 100 into 100 minus the price plus quoted margin times 100 over price. That is the formula for the floater spread for life. That is the formula, where price is the market price per 100 shillings per value. In this question, we are given 99.2510 shillings. That is the price. And the quoted margin is the measure of the basis points, which in this case is 90 basis points. We read that floating rate security which has a floating margin of 90 basis points. So quoted margin in the coupon reset formula measured in basis points is 90 basis points. That is the basis points. Then this price is the same as this market price. So we have all the inputs. This we divide by the maturity. So that is the formula. 100 into 100 minus the price over maturity plus the quoted margin times 100 over the price, where price is the market value of the 100 shillings per value. In this case, it is 99.2510 shillings. Then we have the quoted margin. The quoted margin is the quoted margin in the coupon reset formula measured in basis points. In this question, we have 90 basis points. This is 90 basis points. This is the price, which is the market price of the par value of 100 shillings. And maturity is the number of years to maturity. The number of years to maturity is 7 years. So we have all the inputs. We have all the inputs from the question. All we need is to substitute then get the answer. 100 minus the price, 99.2510 plus quoted margin 90 times 100 divided by 99.2510. This we divide by 7, maturity. That is going to give us the floaters spread for life. Floaters spread for life. I take my machine and calculate. So this will give me 101.46 basis points. So that is the answer to part A, Roman 1. This is Roman 1. Then you have Roman 2. Roman 2, explain the limitations of the spread for life. Limitations of the spread for life. 1, uncertainty around the future. Uncertainty. Now, the spread for life is an estimate that is based on current and historical data, and therefore it cannot predict future changes in the benchmark rate or the credit worthiness of the floating rate note. Right? The credit worthiness of the issuer of the floating rate note, because there are factors that can significantly impact the actual spread, and therefore uncertainty around or about the future is one of the limitations of the spread for life. It is an estimate that is based on current and historical data. Related to uncertainty around the future, we have the limited historical data as a limitation. Limited historical data. Now, if the floating rate note is a new issue, there won't be much historical data to estimate or calculate a reliable spread for life. And that makes it even more challenging to assess the future performance. Limited historical data in reference to, say, a new issue. 3, it doesn't consider reinvestment risk. The spread for life does not consider reinvestment risk. It only reflects the difference between the floating rate notes yield and the benchmark. It does not account for investment risk. And as you receive coupon payments from the floating rate note, you will need to invest them. And if prevailing interest rates are lower when you invest, then your overall return might be lower than anticipated by the spread for life. So it does not consider reinvestment risk. That is a limitation. It also does not capture the call risk. It does not capture the call risk. It does not capture the call risk. Some floating rate notes have call provisions that allow the issuer to redeem the bond early. So if interest rates decline, And if they do so significantly, the issuer might call the floating rate note, forcing you to invest your principal at a potentially lower rate. And that disrupts the expected spread for life. So these are some of the disadvantages of spread for life. Explain two limitations. These are 4. 1, 2, 3, 4. Any two marks. Any two will earn the 2 marks. Part A of this question, 3 marks. Formula, working, answer, 3 marks. We've answered part A. Part B reads, a bond may include a provision that allows the issuer to retire or call all or part of the issue before maturity. Examine 3 disadvantages to an investor of a call provision clause in a bond. Now, this is a question from the topic, the term structure and interest rate dynamics. This is topic number 7, the term structure and interest rate dynamics. Examine 3 disadvantages to an investor of a call provision clause in a bond. B. Disadvantages of a call provision clause in a bond. The first disadvantage is early termination. How is it a disadvantage? Now, if interest rates fall after you buy a bond, the issuer can call the bond and reissue new ones with a lower coupon rate, and you would then be forced to reinvest your principal at a potentially lower rate, reducing your overall return. That is one disadvantage. Number 2, reinvestment risk. Reinvestment risk. Now, when a bond is called, you receive your principal back, but one may struggle to find a new investment with comparable interest rate, especially if rates have declined. And that can be particularly challenging in interest rate environments, in low interest rate environments. So there is that reinvestment risk. So a bond or may be called, but the investor may lack an opportunity to reinvest the principal to earn similar interest rate, particularly where we have challenges in the environment in relation to interest rates. So that is a disadvantage, reinvestment risk. You understand? 3, lack of predictable revenue stream. That's yet another disadvantage of having a bond with a provision clause. Bonds offer a predictable stream of income through coupon payments. A call provision disrupts such predictability, potentially forcing you to find a new source of revenue earlier than expected. Do you understand? 4, reduced liquidity. Reduced liquidity. If a bond is frequently called due to falling interest rates, it can become less liquid, meaning it can be difficult to sell the bond quickly. Why? Because investors become wary of holding such a bond, and that can make it harder to exit the investment if need be. Disadvantages. Another disadvantage could be in relation to the call premium. The call premium may not be enough. Call premium might not be enough. The call premium might not be enough. Sometimes bonds with call provisions offer a slightly higher initial coupon rate to compensate investors for the call risk. However, that premium might not fully offset the potential loss of future interest payments if the rates fall significantly. So these are some of the disadvantages of a call provision clause in a bond. One disadvantage is related to early termination, reinvestment risk, lack of predictable revenue stream, reduced liquidity, call premium might not be enough. 6 marks. Any three disadvantages would earn the 6 marks. That is part B. Part C of this question reads, Zainabu Anyango is analyzing two types of bonds, A and B. Bond A and Bond B, whose information she has gathered as shown below. So we have information in relation to Bond A and Bond B. The information is about the par value, maturity, coupon rate receivable, frequency of interest payments, first interest payments occurs. Bond is held up to interest payments reinvested at 8% and 8% respectively. Required, Roman 1, the present value of annuity interest for Bond A and Bond B, 4 marks. Roman 2, the total value of the constituent components of bonds return for Bond A and Bond B, 4 marks. Roman 3, based on your computations in C1, in C2 above, advise Zainabu on the preferred bond to invest in. So we are required, first of all, to calculate the present value of annuity interest. B. Let's begin with Bond A. What is the present value of annuity interest Bond A? Now, candidates, we know that the present value of an annuity is calculated. The present value is equal to the future value times 1 plus r raised to n minus 1 over r. That is the formula, where future value is the interest annuity interest. The annuity interest, the interest rate from the question, coupon rate receivable is 10% and the par value is 20 million. So it's 10% times 20 million, which is equal to 2 million. That is the future value. That will be equal to 2 million times 1 plus r. R here is the interest payments investment rate of 8% per annum. So 8% converted into decimal is 0.08 plus this one will be 1.08. We raise to the number of years, maturity 15 years, 15 years minus 1 over R 0.08. That's it. This will be the present value of annuity interest bond A. This is equal to shillings 54,304,227.85. That is the present value of annuity interest bond A. For bond B, what is the present value for bond B? The present value for bond B. Now, the annuity interest bond B is the 10% per annum, still 10% per annum. But candidates, you can see the frequency of interest payment here is not annually, but semi-annually. So the interest receivable you've seen here is semi-annually. So the 10% is earned semi-annually. It is 10% per annum, but earned semi-annually. So it's going to be a half of 10%. That will be the rate. You understand? Times the 20 million. The interest will be 5% times 20 million, which is equal to 1 million. This 1 million is earned semi-annually for how many periods? The periods will be the 15 years times 2, 30 periods. Our N here, we have future value times 1 plus R. This R we are dividing by 2. Then this N we multiply by 2 minus 1 over R. Right? R, we said we are dividing by 2. This R we divide by 2. So that will be equal to 1 million. This 1 million times 1.8% divided by 2 is 4%, 1.04 raised to N is 15 years times 2 is 30 years raised to 30 minus 1 over 0.4 over 0.4. That is how to work out the present value of annuity interest. Annuity interest. All right? Annuity interest. So this should be 0.04. 0.04. So I take my machine and get the present value. So the present value here will be equal to shillings 56,084 937 0.75. That is the present value of annuity bond B. We've answered Roman 1. We move on to answer Roman 2. What is the question? Roman 2, the total value of the constituent components of bonds returned for A and B. The total value of the constituent components of bonds return. Constituent bonds return. You understand? The question is not requiring us to calculate the total of bond A and B. No, it is the constituent components of, first of all, bond A, then bonds constituents of bonds returns of B. So we are going to have two separate totals for bond A and bond B. And that will constitute the par value the par value at maturity. Let's begin with bond A. Bond A, first of all, we'll have par value at maturity. The par value at maturity, bond A, is 20 million. 20 million. The par value at maturity is 20 million. Then we'll have the interest payments. The interest payments, we know the interest per annum is 2 million. That is interest per annum is 2 million. And this interest will be earned for a period of 15 years. So we have 2 million times 15 years. That will give the total interest. 15 times 2 million is equal to 30 million. That is 30 million. Then, apart from the interest payments, the coupon, the interest that was reinvested, interest on reinvested interest payments. Interest on reinvested interest payments. This interest that is received, we read from the question, was reinvested. That interest was reinvested to earn interest. Interest, we call it reinvestment income. It can also be known as the reinvestment income. You can see under bond A, interest payments reinvested at 8%. Interest payments reinvested at 8%. So what is this interest payment? So we need to calculate the interest payment that was reinvested at 8%. Now the interest on reinvested interest payments is simple to calculate. We will deduct the interest payments from the present value annuity interest. That will be 54,304,227.85 minus the 30 million. So this is just 30. So here we'll have, we get the difference between the value of annuity interest and the interest payments. So this will be equal to 24. Yeah, 30, 54 minus 30 is just 24 because these are zeros. This is 24. 304.227 0.85. Yes, there is only 1 point there because there are 3 zeros here. So I push my point from this point 3 times. So that is the interest on reinvestment interest payments, also known as reinvestment income. Reinvestment income. So we are going to get the total because the question is total value of the constituent components bonds return for A and B. For bonds return for A and B. This will be equal to, I'm getting the total there, don't need a calculator there, 74,304,227.85. That is the total value of the constituent components of bonds return for A. Then we do the same for bond B. Total value bond B. We have the par value. First of all, at maturity, the par value at maturity for bond B is still 20 million. Then we have the interest payments. We add the interest payments. We had calculated the interest payments bond B is 1 million per period, and there are 30 periods. So it will be 1 million times 30 periods. 1 million times 30 periods, which is equal to 30 million. That is interest payments. Then lastly, we have the interest on reinvested interest. Interest on reinvested interest. Now, to calculate interest on reinvested interest, we take the difference between the present value annuity interest and the total interest. So the present value annuity interest, we had calculated it here, 56 million and 84,937 and 75 cents. This we deduct the 30 minus this 30 million. Let me have it here, minus 30 million. The difference between the annuity interest and the interest payments will give us the interest on reinvested interest. So 56 minus 30, this is 26. These are just zeros, so we have 26, 0, 84, 9, 37. This is 937, 26,084. This is 56 million and 84,937.75. So we are going to get that total. That will be the total value. The total value. Again, I don't need the calculator. This is 20 plus 30, giving me 50 plus 26. 50 plus 26, 76, 084, 937.75. 76 million 84,937 and 75 cents. That is the total value, of the constituent components of bond B. Then we have the last part of that question. Based on your computations in C2 above, advise Zinabu Anyango on the preferred bond to invest in. And candidates, you can see the total return here is 76,084,937.75. The total return bond A, 74,304,227 and 85 cents. That is the total return for bond A. You can see 74 and 76. So bond B has a more reinvestment interest than bond A. Do you see that? Because these two are the same. The par value of maturity is the same. 20 million, 20 million. The interest payments is also the same. The interest payments is the same. So the decision, the advice is based on the amount of interest on invested interest. What determines on which investment to take is dependent on the interest on reinvested interest. And you can see here, bond B has more investment interest than bond A, and therefore bond B is the best investment because interest is reinvested more frequently. In bond B, interest is reinvested more frequently. It is reinvested semi-annually than bond A. So from this question, you can see here, interest is reinvested more frequently. That's why the total reinvestment income for bond B is more than the total reinvestment income for bond A. So the advice here is that Zinabu Onyango should invest in bond B. Zinabu, this is Roman 3, Zinabu Anyango should invest in bond B. What is the reason? Because interest is reinvested more frequently. In bond B, interest is invested more frequently. That is semi-annually than bond A. Consequently, earning higher return on investment. So we've answered question 2, December 2021. Part A, We've moved on to part B. Part C, 4 marks, Roman 1, 4 marks, 1, 2, 1, 2, 4 marks. Roman 2, 4 marks, 1, 2, 1, 2, 1, 2, 4 marks. Then the advice is just 1 mark. 1 mark. So thank you for attending the lesson. In our next session, we are going to answer question number 3, December 2021. Please attempt December 2021 question 3 before attending that lesson. Make sure you go through the question first so that when you are revising, you will learn where your mistakes are and improve. I urge you to look for similar questions in the revision partner for fixed income investments analysis. The question that we've just done is tested from the topic on, that is question 2 is tested from the term structure and interest rate dynamics. Question 3 will be tested from the same topic, the term structure and interest rate dynamics. There is also part B of that question on valuation and analysis of bonds with embedded options. So please attempt the question on the embedded bonds with embedded options, valuation and analysis of bonds with embedded options. Thank you. Bye-bye.
Hello, welcome back to our revision session. In this session, we shall be looking at the December 2021 sitting of advanced taxation. So welcome, and let's solve the questions together. So we start with question 1 of the paper. Question 1 in the current setting is mostly a theory question, and so be keen to be able to look at it keenly. It will always be testing a number of topics, majorly 2 to 3 topics in most cases. So question 1A of December 2021 advanced taxation says, as economies continue to recover from the impact of the COVID-19 pandemic, tax collection in many countries continues to face challenges. This trend has resulted in some revenue authorities resorting to some drastic measures to boost tax revenue. One recent measure taken in monitoring of social media accounts and postings is, to access taxation compliance. Required. Justifying your response with practical reasons, argue the case for or against monitoring of social media accounts to assess taxable capacity and compliance. Note, marks will only be awarded for one position taken. Now, this question is testing what we call emerging trends in taxation. So that reminds you to be keen on all the subtopics in that topic, including issues like high tax, COVID-19 and taxation, tax agents, tax experts, and all that. So in this particular case, we are looking at the impact of COVID-19 in taxation and what tax authorities have resorted to do for them to boost their tax collection. So let's pick the question again. Justifying your response with practical reasons, argue the case for or against monitoring of social media accounts to assess taxable capacity and compliance. And we are told marks will only be awarded for one position taken. So in this case, you were to take one position. That means you are either to argue for or against the monitoring of social media accounts by tax authorities to boost tax collection. But for learning purposes, I've looked at both sides of the coin, so I'll then be discussing arguments for and against monitoring of social media accounts. But in exams, please in such a question, take one position and talk about it in detail. So one, I'm talking about arguments for monitoring of social media accounts to assess taxable capacity and compliance. Now, today, many business activities are done digitally. So then digitalization and rise of social media has changed the way businesses or other firms conduct their businesses. A lot of firms today do their marketing activities online. A lot of them conduct business and communicate with their stakeholders online. And therefore, the move by KRA and other tax authorities to monitor social media accounts helps such authorities to maximize on their tax administration, and therefore digitalization, in short, and the rise of social media accounts enhances the way people conduct business today, and therefore the move by KRA to monitor social media accounts is a new frontier in tax administration. Number two is that tax is a constitutional obligation that everyone has to bear fairly, and therefore all people must pay taxes, and therefore nobody is to pay a shilling less or more than what they should actually pay. And therefore, the move by KRA to monitor social media postings is therefore a good one to complement the traditional methods or traditional tools that were used by such authorities to ensure tax compliance and administration. Three is that monitoring of social media accounts supplement what we call lifestyle audit activities, such as wealth declaration by taxpayers, in order to determine whether such taxpayers are tax compliant or not. And through such audits, such authorities, including KRA, have been able to make or rather take enforcement actions against non-compliant taxpayers. In other words, I'm saying that monitoring of such social media accounts supplement or complement lifestyle audits by tax authorities to ensure maximum tax compliant by taxpayers. So those are some of the arguments for. And as I said, I'm looking at both sides of the coin. So the second bit, I'm looking at arguments against social media monitoring by tax authorities. One is that most tax regimes, including Kenya's tax system, is based on what we call self-assessment by taxpayers, founded on honesty and trust, where taxpayers are required to voluntarily disclose information about their incomes to their tax authorities. And therefore, monitoring of social media accounts by tax authorities goes against this trust and voluntary declaration of incomes by taxpayers. Two is that social media monitoring by KRA and other tax authorities goes against what we call freedom of expression through the Constitution, as well as other instruments like the international instruments, such as the Article 19 of the UN Human Rights Convention. For many social media users, their postings and communication through social media is just for fun and for keeping their friends informed about their activities and lives. And so, when KRA and other tax authorities start monitoring such social media accounts, it infringes the the right of expression or the freedom of expression of such taxpayers. Three is that social media mining by tax authorities, including KRA, may or might punish those who cultivate false image of themselves in the social media or online. In some survey conducted by the British social media users, more than 75% of the people admitted that they were lying about themselves on social media. And that happens in Kenya and all over the world. Many people post information on social media which are not necessarily true about themselves. So today, for example, if I take photos in front of big mansions or big cars every single day and I keep changing them, if I post search on social media, that is not necessarily, may not necessarily be me. And so if KRA uses such information to determine or that to say that I'm not paying taxes as required, then that may not be true. I may end up being punished falsely just because I'm passing information on social media that may not be true about myself. So such as some of the arguments for and against the use of social media, or rather social media mining by KRA and other tax authorities across the world. That is part A of the question. The question is all theory, remember. So I move to part B of the question. It says, a delegation comprising government officials and entrepreneurs from a neighboring countries has visited your country, which is a beneficiary of the African Growth and Opportunity Act, AGOA, to learn more on AGOA and its benefits. A delegation comprising government officials and entrepreneurs from a neighboring country has visited your country, which is a beneficiary of the African Growth and Opportunity Act, AGOA, to learn more on AGOA and its benefits required. Prepare a brief to be presented to the delegation covering the following. Prepare a brief to be presented to the delegation covering the following. 1 is background information on AGOA. 2, conditions to be considered as an AGOA beneficiary country. And 3, trade benefits provided under AGOA. Now, this is a question on the topic economic integration. Now, economic integration in short is simply the grouping together of countries in a given geographical region for purposes of promoting trade among themselves. Now, that reminds you to look deeply into trading blocks, especially the East African Community, COMESA, and so on and so forth. But this particular one is on AGOA, that is African Growth and Opportunity Act, AGOA. Now, this is the background information on AGOA. AGOA is a piece of legislation that was approved by the U.S. Congress on 18th May, the year 2000. AGOA is a piece of legislation that was approved by the U.S. Congress on 18th May 2000. The objective of this legislation is to assist economies of the sub-Saharan African countries to improve the economic and to improve the economic relations between the United States and the region. AGOA completed its initial period of validity, and that was in the year 2015. And therefore, it was extended on 29th June 2015 by a further 10 years to 2025. Now, each year, the U.S. President determines the eligible countries from the sub-Saharan Africa to be part of the AGOA. Then AGOA provides duty-free treatment to goods designated from such sub-Saharan African countries to promote the economic growth through governance and free trade. In other words, the aim of AGOA is to assist the sub-Saharan economies to grow and promote trade between that region and the United States. So the key points to note here is 1, the formation of AGOA. Number 2, the countries forming AGOA. And 3, the key objective of AGOA. So let me pick it again, as you may be noting. Number 1, I've said that AGOA is a piece of legislation that was formed and approved by the U.S. Congress on 18th May 2000. The objective of the legislation is to promote and assist the economies of sub-Saharan African countries and to improve their economic relations with the United States. Then AGOA completed its first 15-year period of validity in 2015 and was further extended by 10 years to end in 2025. Then each year, the U.S. President determines the eligible countries from the sub-Saharan Africa for the AGOA. Then how does AGOA benefit such countries? So last